Preface. The discipline behind the fortune. Fortunes attract mythology. Once an investor becomes famous, people compress decades of work into a slogan. Buffett becomes patience. Soros becomes the currency trade. Simons becomes mathematics. Dalio becomes diversification. Lynch becomes buying what you know. Icahn becomes activism. These summaries are convenient, but they are incomplete. They remove the difficult parts. The years of preparation, the losses, the waiting, the risk controls, the mistakes, the choice of partners, the refusal of unsuitable opportunities, and the willingness to appear wrong before the result became visible. Great investing is rarely one dramatic decision. It is a series of disciplined judgments made under uncertainty. The investor studies, waits, acts, monitors, admits error, reallocates, and begins again. The glamour exists in hindsight. The daily practice is quieter. This book is organized as 48 laws because a law is easier to remember than a lecture. Each law captures one recurring principle of capital stewardship. The laws are not rigid commands. They are decision tools. Markets change too quickly for mechanical certainty, but human behavior and economic reality repeat often enough to make principles useful. The laws move in a deliberate order. First comes self-government, because an investor who cannot govern his mind cannot govern money. Next comes valuation in business economics. Then capital allocation, risk, cycles, and the practice of mastery. The final laws reach beyond securities toward reputation, purpose, and the meaning of enough. A reader may be tempted to skip directly to the laws about valuation or opportunity. Resist that temptation. The most dangerous investment errors are often not mathematical. They are errors of identity, incentives, time horizon, and emotional control. A brilliant model cannot save an investor who cannot accept contradictory evidence. Read slowly. Disagree where necessary. Write in the margins. Apply each law to an actual investment, business, property, or decision. The value of this book will not come from remembering its language. It will come from changing behavior. Introduction. The difference between having money and understanding capital. A person can possess a great deal of money without understanding capital. He may have inherited it, earned it through a profession, sold a company, accumulated real estate, received a settlement, or benefited from a market that rewarded nearly every participant. Money answers a simple question. What do you possess today? Capital asks a harder question. What can this resource become tomorrow, and what risks must be accepted along the way? The difference between money and capital is stewardship. Money can be spent. Capital must be allocated. Money can sit in an account. Capital always exists among competing choices. It can be invested in a business, a security, a property, a bond, a fund, a loan, a technology, an education, or a relationship. It can be returned to shareholders, used to repay debt, preserved as liquidity, or committed to an acquisition. It can expand freedom or finance a mistake. Every dollar has several possible destinations and can occupy only one of them at a time. That creates opportunity cost. A dollar committed to one asset is unavailable for another. A net or unproductive investment. Capital locked inside a fragile structure may be unavailable when a rare opportunity appears. Investing is therefore not merely the search for assets that may rise. It is the continuous ranking of alternatives. The amateur asks, what will go up? The serious allocator asks a different sequence of questions. What is the asset? How does it produce economic value? Who controls it? What incentives govern those people? How much capital does it require? What can damage its earning power? How much expected success is already reflected in the price? What happens if the forecast is wrong? Can I survive the downside? Is this opportunity superior to doing nothing? The last question is regularly ignored. Doing nothing is also a capital allocation decision. Professional markets create pressure to act. Fund managers are expected to remain invested. Analysts are expected to publish opinions. Traders are expected to trade. Private equity firms are expected to deploy committed capital. Often through growth, financial media must manufacture a continuous stream of urgency. The individual investor possesses an advantage institutions often surrender. He can decline. He can allow an opportunity to pass without defending the decision before an investment committee, client, audience, or quarterly earnings call. That advantage exists only when patience is emotionally tolerable. Many people cannot endure the discomfort of watching others become richer, even temporarily. They would rather participate in an overpriced market than appear foolish while holding cash. They do not fear loss as much as they fear exclusion. This is why investing begins with psychology. 4 forms of risk. Risk is often reduced to price volatility. That definition is inadequate. A volatile asset may retain its long-term earning power. A stable-looking investment may conceal leverage, illiquidity, fraud, customer concentration, or refinancing danger. Fundamental risk appears when the asset produces less economic value than expected. A company loses customers, margins decline, a property becomes obsolete, a borrower defaults, a competitive advantage disappears. Financial risk appears when the asset or investor cannot survive long enough for the thesis to work. Debt matures, interest expense rises, covenants are violated, collateral values fall. Capital must be raised on destructive terms. Valuation risk appears when the asset performs reasonably well, but the purchase price was too high. Earnings may rise while the investment disappoints because the entry valuation required perfection. Behavioral risk appears when the investor damages his own result. He buys after excitement has inflated the price, sells during panic, increases a position to recover a loss, borrows because recent success created overconfidence, or abandons a sound process after a short period of underperformance. These risks interact. A leveraged company purchased at an extreme valuation during a speculative market can contain all four. The purpose of these 48 laws is not to eliminate uncertainty. That cannot be done. The purpose is to make uncertainty survivable. The investor's real edge people often search for an informational edge. They want to know something the market does not. Such advantages exist, but they are difficult to sustain. Information travels quickly. Institutions employ analysts, engineers, economists, industry experts, data scientists, and alternative data providers. Other advantages remain available. A longer time horizon is an advantage. A willingness to hold cash is an advantage. Emotional stability is an advantage. The absence of forced selling is an advantage. Specialized knowledge of a narrow industry is an advantage. The ability to investigate a small private company ignored by institutions is an advantage. The courage to say no is an advantage. The sophisticated investor builds around advantages he truly possesses rather than advantages he wishes he possessed. What this book requires, this book will not ask you to worship famous investors. Study them, but do not surrender your judgment to them. It will not argue that one asset class, strategy, or philosophy is always superior. Every method has conditions in which it succeeds and conditions in which it fails. It will not ask you to become fearless. Fear contains useful information. It becomes destructive only when it replaces analysis. It will ask you to become honest about what you understand, why you bought, what risk you accepted, whether the thesis is working, how much luck influenced the result, and whether wealth is serving your life or controlling it. Those are difficult demands. They are also the foundation of enduring capital stewardship. Law 1. Protect the mind before you protect the money. Capital is usually lost in the mind before it is lost in the market. The investment did not begin with a spreadsheet. It began at dinner. A business owner had recently sold the company he had built over 3 decades. For the first time, most of his net worth existed outside the enterprise that had structured his life. The sale made him wealthy, but it also removed the place where his experience gave him confidence. Several friends were discussing an asset that seemed to rise every week. The idea was new enough to feel revolutionary and popular enough to feel validated. People who had entered months earlier spoke with the certainty of veterans. He asked reasonable questions. What produced the value? Who controlled the structure? How would it behave if liquidity tightened? The answers were vague, but the price continued upward. Caution began to feel expensive. Each week of hesitation seemed to prove that the cautious man understood less than the confident crowd. His concern changed. At first he feared losing money. Then he feared being left behind. That shift was decisive. He made a small investment. It rose quickly. The gain felt like evidence, so he increased the position. When the price declined, he did not revisit the economics. He interpreted the decline as a chance to buy more. When contrary facts appeared, he searched for people who supported his original decision. By the time the asset collapsed, the position had become connected to his identity. The money disappeared after the market turned. The capital had been endangered earlier, at the moment his mind stopped investigating and began defending. The inner manager markets do not force irrationality. They offer invitations. A rising price invites greed. A falling price invites panic. A popular idea invites imitation. A public prediction invites pride. A large loss invites denial. Recent success invites overconfidence. Intelligent people often assume their intelligence protects them. It can do the opposite. A clever mind can construct a persuasive explanation for almost any choice. Fear becomes risk management. Greed becomes conviction. Imitation becomes market confirmation. Stubbornness becomes long-term thinking. Once money and reputation attach themselves to an idea, the mind may quietly change jobs. It stops acting as an impartial judge and becomes the attorney for the existing position. The safeguard is not a promise to be rational. The safeguard is a process that remains usable when objectivity is under pressure. The emotional sequence. A destructive decision often moves through a recognizable chain. Curiosity opens the door. Social proof lowers suspicion. A small purchase creates emotional ownership. An early gain converts luck into confidence. The position grows faster than understanding. Contradictory evidence appears. The investor searches for reassurance. Finally, identity attaches to the thesis, and selling begins to feel like humiliation. The sequence can be interrupted, but only before the emotional pressure becomes overwhelming. Envy is especially dangerous because it disguises itself as opportunity. Instead of asking whether an asset offers an attractive risk-adjusted return, the investor asks why someone else is becoming richer faster. The neighbor's gain becomes evidence. The colleague's new house becomes evidence. The screenshot becomes evidence. None of these explains what the asset is worth. Boredom creates a different trap. Compounding often looks uneventful. A durable company grows gradually. Debt declines, cash accumulates, and management executes without drama. A speculative asset moves 20% in a day. The bored investor mistakes activity for progress and replaces an effective machine with an entertaining uncertainty. Investing is not obligated to provide excitement. Lessons from different masters. Warren Buffett's record is associated with patience, but the deeper trait is emotional independence. Holding a sound asset through years of disagreement requires a mind that does not depend on daily approval. George Soros offers the complementary lesson. Independence does not mean refusing to change. He became known for acting forcefully when conviction was high and for reversing when evidence invalidated the thesis. Conviction comes from evidence. Attachment survives by ignoring evidence. Jim Simons approached emotion structurally. Quantitative rules can reduce the influence of mood and narrative. A model does not eliminate error. It relocates error into data quality, design, execution, and adaptation. The valuable insight is that recurring decisions should not be reinvented under pressure. Main Street and Wall Street. The same psychology appears in private deals. A buyer spends months on diligence, pays advisors, introduces lenders, and imagines the identity of ownership. New information then reveals severe customer concentration. The emotionally committed buyer asks how to keep the transaction alive. The disciplined buyer asks whether the revised risk still justifies the price and structure. Past effort is a sunk cost. Public markets create continuous feedback. A business may report results quarterly while its price moves every second. That mismatch encourages investors to respond to price far more frequently than the underlying evidence changes. Price can be observed daily without allowing the thesis to be rewritten daily. Final principle: the first asset under management is not money. It is the mind responsible for the money. A disciplined mind can recover from loss, recognize opportunity, and rebuild. An undisciplined mind can inherit wealth, earn wealth, temporarily multiply wealth, and still discover a way to destroy it. Before asking whether an investment is safe from the market, ask whether the decision is safe from you. Law 2. Define the game before you enter it. A strategy cannot be judged until the objective, horizon, and constraints are known. Two investors can buy the same company on the same day and make opposite decisions a month later without either being irrational. The first is a merger arbitrage specialist. He bought because the spread between the market price and the announced acquisition price offered a calculable return if the deal closed. The second is a family office buying a business expected to compound for 15 years. When regulators delay the transaction, the arbitrage specialist may exit because the probability and timing changed. The family office may welcome the decline if the long-term economics remain intact. They own the same ticker. They are playing different games. Confusion begins when people borrow a strategy designed for another player's objectives. A retiree copies a leveraged trader. A short-term fund manager imitates a permanent owner. A private business buyer uses public market liquidity assumptions. A founder treats operating cash as though it were speculative capital. The instrument does not define the game. The purpose does. 6 elements of the game before capital is committed. Define 6 elements. First, identify the objective. Is the goal income, preservation, absolute return, growth, control, diversification, tax efficiency, or strategic access? A portfolio designed for current distributions will not look like one designed for maximum long-term appreciation. Second, define the horizon. A 5-day trade and a 20-year ownership position require different research, position sizing, and tolerance for interim movement. Third, understand liquidity needs. Capital needed for payroll, tuition, debt service, or a near-term purchase should not be placed in assets whose exit depends on favorable markets. Fourth, state the loss capacity. Emotional tolerance matters, but financial capacity matters more. A person may feel comfortable with risk while lacking the balance sheet to survive it. Fifth, identify the source of edge. Speed, information structure, patience, control, industry knowledge, and tax position are different advantages. A strategy without an edge is merely exposure. Sixth, define the scorecard. Performance must be compared with a relevant objective, not with the most exciting asset of the year. The wrong benchmark. Many investors become dissatisfied with a sound plan because they compare it with somebody else's game. A diversified portfolio may be fulfilling its purpose while a concentrated technology fund rises faster. The diversified investor abandons his design to chase the winner. When conditions reverse, he discovers that he adopted the return pattern without possessing the risk tolerance or time horizon that made the strategy survivable. Benchmark envy is often more destructive than market volatility. A private equity fund may accept illiquidity because it expects control, operational influence, and a long hold. An individual buying a minority interest in a small private company may receive the illiquidity without the control. The asset class label is the same. The game is not. Time horizon as a competitive advantage. Long horizons are often praised, but duration alone is not virtue. Waiting patiently inside a deteriorating business is not sophisticated. A long horizon becomes an advantage only when the asset can compound and the investor can remain financially independent of the market's short-term opinion. Short horizons can also be rational. Market makers, arbitrageurs, and event-driven investors may build excellent businesses around brief holding periods. Their discipline lies in matching analysis to the event and exiting when the defined opportunity ends. The mistake is not short-term or long-term investing. The mistake is changing horizons to avoid admitting error. A failed trade becomes a long-term investment after the price falls. A carefully researched ownership position becomes a trade because the market rises quickly. A private business example: consider an entrepreneur buying a regional service company. If his objective is long-term ownership, he may accept lower initial cash flow to fund systems, management, and geographic expansion. If his objective is resale within 3 years, the same investment program may not produce visible returns before exit. The capital plan must match the intended game. A strategic buyer may pay more than a financial buyer because the acquisition creates distribution, procurement, technology, or customer advantages elsewhere in the organization. The higher price can be rational for one buyer and reckless for another. Value is partly dependent on the owner who can realize it. Your investment constitution. Write a one-page constitution before building a portfolio. It should answer, what must this capital accomplish? When might it be needed? Which losses would impair life obligations? Which risks am I qualified to evaluate? How much illiquidity can I accept? What is my comparison standard? Which decisions require outside review? What circumstances permit leverage? What behavior is prohibited even when profitable? A constitution is useful because rules written in calm conditions can govern behavior during emotional ones. Final principle. Never ask whether a strategy is good in the abstract. Ask whether it is suitable for the game you are actually playing. The sophisticated investor does not win by copying the strongest player on another field. He wins by knowing his own field, his own constraints, and the exact score that matters. Law 3. Never invest borrowed conviction. Research must become personal understanding before capital becomes commitment. A persuasive person can make uncertainty feel like knowledge. He may possess a respected title, an impressive record, a large following, or the calm tone of someone who has never been surprised. He explains the opportunity in a way that removes complexity. The market is wrong. The catalyst is near. The downside is limited. The upside is enormous. The listener feels relief. Independent thought is difficult. Borrowed certainty is comfortable.
The weakness appears when the price declines.
The original speaker is unavailable, changes his view, or reveals that his position was smaller than assumed. The investor owns an asset he cannot explain and a loss he cannot interpret. He does not know whether the decline is opportunity or warning because the conviction was never truly his. Information is not understanding. Reading a report, listening to an interview, or receiving an investment memo can begin research. It cannot complete it. Understanding requires the investor to reconstruct the thesis in his own language.
How does the asset create cash? What assumptions matter most? Which variable could invalidate the case?
What does the balance sheet permit? Who benefits if the story is believed? How sensitive is value to growth, margins, interest rates, or exit price? If the thesis cannot be explained without repeating another person's phrases, it has not yet become knowledge. Borrowed conviction is especially dangerous in concentrated positions. The more capital placed behind an idea, the greater the need for personal comprehension. A diversified investor may survive several misunderstood holdings. A concentrated investor cannot. Authority and incentives expertise deserves respect, but authority must be examined alongside incentives. An analyst may be paid to maintain coverage. A fund manager may be explaining a position already owned. An investment banker may benefit from the transaction. A founder may possess extraordinary knowledge of the product while remaining optimistic about valuation. A social media commentator may earn attention from certainty rather than accuracy. This does not mean the information is false. It means the source's economic position belongs inside the analysis. The disciplined question is not, can this person be trusted? It is, what does this person know? What might this person not know? And how are the incentives arranged? The difference between delegation and abdication investors often hire managers, advisors, and specialists. Delegation can be intelligent. Abdication is not. A client does not need to reproduce every trade inside a quantitative fund, but he should understand the strategy's broad source of return, liquidity terms, leverage, fee structure, historical drawdowns, operational risks, and conditions under which the method may fail. A limited partner in private equity may not control every acquisition, but should understand the mandate, incentives, use of debt, valuation discipline, portfolio concentration, and reporting quality. The investor may delegate execution. He cannot delegate responsibility for choosing whom to trust. The conviction ladder builds conviction in stages. Begin with the external idea. Someone points to an asset, industry, or dislocation. Move to primary evidence. Read filings, contracts, financial statements, regulatory records, customer reviews, industry data, and direct management communications. Develop an independent model. Use conservative assumptions and test the variables that matter. Seek disconfirming evidence. Find intelligent critics, failed competitors, historical analogies, and reasons the apparent opportunity may be illusory. State the thesis from memory. If it cannot be explained clearly, more work is needed. Finally, size the position according to both knowledge and downside. A strong idea may still deserve a small allocation if uncertainty is high. Peter Lynch and Ordinary Observation. Peter Lynch emphasized that ordinary life can reveal investment ideas before formal research catches up. A crowded store, a popular product, or a new service can be a useful clue. The clue is not the conclusion. A great product may belong to a heavily indebted company. A growing chain may be opening stores with poor unit economics. A beloved brand may already trade at a price that assumes decades of perfection. Observation creates an investigative advantage only when followed by financial work. A deal room test in a private acquisition. Ask every member of the team to write the thesis independently before the final investment committee. If the group uses identical language, it may be repeating the sponsor's narrative rather than reaching separate conclusions. Ask the junior analyst to explain the business without slides. Ask the operating partner to identify what cannot be fixed. Ask the lender what scenario creates a covenant problem. Ask the customer reference what would cause departure. Independent perspectives reveal whether conviction rests on a foundation or an echo. Final principle advice may introduce an opportunity. It cannot carry the emotional weight of ownership through a crisis. When the market turns, the investor will be left alone with the asset, the evidence, and the consequences. Conviction must be strong enough to survive that solitude and flexible enough to surrender when facts change. Borrow ideas freely. Borrow certainty from no one. Law 4. Think in probabilities, not promises. The future is a range of outcomes, not a single line in a spreadsheet. An acquisition model often begins with a base case. Revenue grows at a stated rate. Margins improve, debt declines. The exit multiple remains reasonable. The spreadsheet produces a return that looks precise to one decimal place. Precision can create an illusion of certainty. The real future contains a customer loss, a competitor's response, a recession, a pricing opportunity, an unexpected manager, a delayed integration, a refinancing window, and several events nobody thought to model. The base case may be useful, but it is only one path through a forest of possibilities. Sophisticated investors do not demand a single forecast. They study distributions. Scenario thinking, a useful analysis, includes at least 4 cases. The resilience case asks what happens when several important assumptions disappoint at the same time. It is not designed to frighten the committee. It is designed to identify whether the structure survives. The conservative case assumes ordinary execution with limited help from the market. The central case reflects the most defensible path, not the most convenient one. The exceptional case considers upside that may be available, but is not required for the investment to work. The investor then estimates approximate probabilities and examines the weighted result. The numbers will not be exact. Their purpose is to expose hidden dependence. If almost all value comes from the exceptional case, the opportunity is speculation wearing a model. Asymmetry matters more than hit rate. An investor can be wrong frequently and still succeed if losses are small and gains are large. Another can be right most of the time and fail because the occasional loss is catastrophic. This is the essence of asymmetry. Venture portfolios accept many failures because a small number of winners can return the fund. Merger arbitrage may produce frequent modest gains while remaining exposed to occasional large losses when a deal breaks. Selling insurance-like instruments can look consistently profitable until a rare event arrives. The percentage of winning decisions is incomplete without the size of gains and losses. Expected value asks a better question. Across the range of outcomes, what is the average economic result, and can the investor survive the path required to realize it? Probability is not passivity thinking. Probabilistically does not mean refusing to act. It means acting with calibrated confidence. A 70% thesis can justify a meaningful position if the downside is limited and the upside is attractive. A 90% thesis may deserve little capital if the remaining 10% contains ruin. Position size should reflect both likelihood and consequence. George Soros' famous macro decisions illustrate a related principle. Conviction can be high when an imbalance appears unsustainable, but the investor must remain attentive to timing and feedback. A correct long-term view can still produce a loss if the position cannot survive the rout. Updating without whiplash probabilities should change when evidence changes. They should not change merely because price moves. A company may fall 20% because the market is fearful. If cash flows, competition, financing, and management remain intact, intrinsic value may be little changed. Conversely, a rising price does not improve the probability of business success. It may reduce expected return. Bayesian thinking, in practical language, means beginning with a reasonable prior view and updating it in proportion to the strength of new evidence. A minor rumor should cause a minor adjustment. A covenant breach deserves more. The departure of a key customer may transform the thesis. The pre-mortem before investing. Imagine that the decision has failed. It is 3 years later and the capital is impaired. Write the most plausible explanation. This exercise releases people from the social pressure of predicting success. It encourages the group to name risks that optimism suppresses. Then perform the reverse. Imagine the investment became exceptional. What occurred beyond the base case? This identifies optionality without requiring the upside to justify entry. A probability worksheet for every material position, record, the 4 most important outcomes, approximate probability of each, gain or loss under each outcome, time required for resolution, liquidity during the holding period, evidence that would increase or reduce each probability, the maximum loss the portfolio can tolerate, whether the decision remains attractive without the best case. Revisit the worksheet after significant information arrives. Preserve the earlier version. The history will reveal whether you update rationally or merely follow price. Final principle promises belong to sales presentations. Probabilities belong to capital allocation. The goal is not to predict one future with theatrical confidence. The goal is to understand enough possible futures that no ordinary surprise can destroy the investor. Law 5. Separate intelligence from outcomes. A profitable result can come from a poor decision, and a sound decision can experience a loss. A man walks into a casino, places his savings on a single number, and wins. The outcome is excellent. The decision remains reckless. Another investor purchases a conservatively financed business below a careful estimate of value. An unforeseen legal change damages the industry. The investment loses money. The outcome is painful, but the original process may still have been rational. Investors naturally judge decisions by results because results are visible. The quality of reasoning is harder to observe. This creates 2 dangerous errors: rewarding luck and punishing discipline. The outcome bias. When a risky position rises, the investor feels validated. He may increase size, borrow money, or repeat the method. The favorable outcome hides the fragility of the process. Eventually, the same behavior meets a different environment. When a sound process suffers a temporary loss, the investor may abandon it just before the conditions for success return. Institutions are particularly vulnerable because clients judge quarterly performance while strategies may require years. A process must therefore be evaluated independently from any single result. Decision quality. A high-quality investment decision contains several elements. The objective is clear. Relevant evidence is gathered. Incentives and conflicts are examined. Alternative explanations are considered. Valuation includes a range rather than a point estimate. Downside and liquidity are understood. Position size reflects uncertainty. Conditions for exit are identified. The decision is documented before the outcome is known. None guarantees profit. Together, they improve the odds of survival and learning. Luck has two faces. Good luck is dangerous because it teaches the wrong lesson. A trader who earns money during a broad speculative rise may attribute the gain to selection skill. A property owner who benefits from falling interest rates may believe every renovation decision created the value. A private equity sponsor who exits into multiple expansion may overestimate operational improvement. Bad luck can also distort learning. A disciplined investment that encounters a low probability shock may be wrongly classified as foolish. The correct response is not to excuse every loss as bad luck. It is to decompose the result. How much came from business performance? How much from valuation change? How much from leverage? How much from the market environment? Which elements were controllable? The return attribution habit for public equities break total return into earnings growth, dividends, share count change, and valuation multiple movement. A company may have performed well while the investment return was weak because the starting price was excessive. For a leveraged acquisition, separate operating improvement, debt paydown, acquisitions, and exit multiple. If most return came from selling at a higher multiple, the process may be less repeatable than the headline suggests. For real estate, distinguish net operating income growth, capital expenditures, financing, and capitalization rate change. Attribution transforms a result into information. Jim Simons and the Value of Many Observations Quantitative Investing recognizes that one trade reveals little. A signal is judged across many observations, different periods, transaction costs, and changing regimes. A method that depends on a few spectacular examples may be storytelling rather than evidence. The individual investor can apply the same principle without advanced mathematics. Keep a decision journal. Review groups of decisions. Look for recurring strengths and failures. Did you consistently underestimate capital intensity? Did you sell winners too early? Did you overpay for charismatic management? Patterns appear only when memories are preserved, the investment post-mortem. Ask 5 questions. First, what did we believe at entry? Second, what actually happened operationally and financially? Third, which assumptions were wrong and why? Fourth, which part of the result came from luck, market conditions, or timing? Fifth, what change in process will reduce the probability of repeating the error? Avoid the lazy conclusion, we should have known. Specify what evidence existed, whether it was available, and why it was ignored. Final principle. The market can reward a bad decision long enough to make it habitual. It can punish a sound decision long enough to make discipline feel foolish. A sophisticated investor respects results but studies the process beneath them. Wealth is not built by being fortunate once. It is built by creating a method that deserves favorable outcomes across many decisions. Law 6. Keep ego out of the portfolio. Capital should never be sacrificed to protect pride. A fund manager presents a concentrated thesis to clients. The position becomes public. Interviews are given. The argument is repeated with confidence. As evidence weakens, the financial question becomes entangled with a social one. What will people say if the manager changes his mind? The original investment may have represented 10% of the portfolio. The public identity now represents much more. Ego transforms an asset into a referendum on intelligence. Once that happens, objective analysis becomes difficult. The investor no longer asks whether the thesis remains valid. He asks whether he can endure the embarrassment of admitting that it does not. The purchase price has no feelings. Markets do not know where you bought. A stock trading at $40 does not remember that you paid $60. The desire to get back to even has no economic foundation. The correct question is always forward-looking. Given today's price, evidence, alternatives, taxes, and risk, would I choose this position now? Anchoring to the purchase price can keep capital trapped in a weak asset, while better opportunities pass. It can also cause a good asset to be sold simply because it reached an arbitrary gain target. Public commitment, public predictions increase psychological cost. The more loudly an investor defends a thesis, the harder it becomes to revise. This does not mean ideas should remain secret. Discussion improves thinking. The discipline is to frame every public statement as a current judgment subject to evidence, not a permanent declaration of identity. Bill Ackman's career offers useful lessons on both conviction and the hazards of prolonged public battles. Concentrated activism can create value when analysis is strong and influence is real. It can also magnify reputational and financial pressure when the thesis becomes a public contest. The principle is not to avoid conviction. It is to preserve the right to change. Status assets ego also appears through the ownership of prestigious assets. Investors may prefer a famous company, landmark property, elite fund, or fashionable strategy because ownership communicates status. The asset may be sound, but the motive weakens price discipline. A buyer who wants the trophy more than the return becomes the ideal counterparty for the seller. The same pattern appears in corporate acquisitions. Executives may pursue larger targets because scale increases personal importance. The acquisition is described as transformational. Shareholders receive dilution, debt, and integration risk. Management receives a bigger empire. The humility premium humility is not timidity, it is accurate self-measurement. A humble investor can hold a large position when evidence supports it because he has already considered how he may be wrong. He can also exit quickly because the decision is not a defense of self-worth. Humility lowers the emotional cost of updating. That makes it economically valuable. A red team rule for every position above a chosen size. Appoint a person or process to argue the opposite case. The critic should have access to the same information and freedom to challenge management, assumptions, and valuation. If you invest alone, write the strongest bear case as though you were being paid to persuade a skeptical committee. Do not create a weak opponent. Steelman the criticism. Then identify the facts that would prove the critic correct. Monitor those facts more closely than the daily price. Language that reveals ego. Notice phrases such as, "I cannot sell down here." The market has to recognize this. "I have too much work invested to walk away. Everyone knows me for this position. I will prove them wrong. It is not a loss until I sell." These are statements about identity, fairness, or social perception. None is a valuation method. Final principle. The market does not award points for consistency of opinion. It rewards the ownership of future cash flows at sensible prices and punishes fragility without concern for reputation. Changing your mind is not weakness when the evidence changes. Refusing to change because other people are watching is an expensive form of vanity. Protect the capital. Pride can recover on its own. Law 7. Write before you buy. A written thesis protects the investor from rewriting history. Memory is a skilled editor. After an investment succeeds, the mind remembers the insight and forgets the uncertainty. After it fails, the mind remembers the warning signs and forgets how persuasive the opportunity once appeared. Without a contemporaneous record, investors become unreliable historians of their own decisions. A written thesis creates a snapshot of belief before price movement, social pressure, and hindsight alter the story. It forces vague confidence into testable language. What the record should contain. Begin with a one-sentence thesis. The sentence should describe the economic reason the investment is attractive, not merely the expectation that price will rise. Then explain the business model or return mechanism. Identify the cash source, the parties involved, and the conditions required for value to be realized. Estimate value using a range. Record the assumptions that create the low, central, and high cases. List the 3 strongest risks. Avoid generic words such as competition or recession. State how the risk would damage the thesis. Name the catalyst if one is required. Some assets can compound without an external event. Others need refinancing, restructuring, regulation, a sale, or a change in control. Define the holding period, position size, and liquidity needs. Finally, state the kill criteria. Evidence that would cause reduction or exit even if the price is painful. Writing exposes weakness. An idea that sounds compelling in conversation may collapse on paper. The investor discovers that the thesis depends on 5 favorable assumptions: management credibility, low interest rates, and a high exit multiple. That discovery is valuable. The purpose of writing is not to make every idea look professional. It is to reject weak ideas before they become expensive. A good memo also separates facts from interpretations. Revenue grew 12% is a fact. The company is taking share is an interpretation that may require more evidence. The distinction prevents narrative from hiding uncertainty. The private equity investment memo institutional investment committees use memos because large decisions require a durable record. The best memos do more than support approval. They create accountability after closing. A useful private company memo should include customer concentration, recurring revenue, normalized earnings, working capital, maintenance capital expenditure, management dependence, competitive position, debt capacity, integration requirements, and the path to exit. The memo should also document what the deal team chose not to believe. If management's projections were reduced, record why. If a synergy was excluded, preserve that discipline. Years later, the committee can compare actual performance with the underwriting rather than with a revised memory.
Monitoring through questions, turn the thesis into a monitoring dashboard.
If the case depends on customer retention, track retention. If pricing power matters, examine realized price, volume, and churn. If debt reduction creates value, monitor cash conversion and covenant headroom. If a technology transition is central, measure adoption rather than press coverage. A dashboard should follow the thesis, not whatever data management finds easiest to present. The decision journal creates 3 entries. The entry memo records the thesis. The update memo is written when major evidence changes. It should explain what changed, whether value changed, and whether the position should be resized. The exit memo explains the reason for sale and what the investor learned. Over time, the journal becomes a private library of judgment. It reveals recurring errors that no textbook can identify because they belong specifically to you. A 1-page template used these headings. Opportunity in 1 sentence. How the asset creates value. Current price and estimated value range. 3 decisive assumptions. Principal downside paths. Balance sheet and liquidity review. Source of edge. Position size and reason. Evidence to monitor. Conditions for exit. If the case cannot survive 1 clear page, additional pages may be concealing rather than clarifying. Final principle writing slows the moment between desire and commitment. It converts enthusiasm into claims that can later be tested. The investor who writes before buying gains 2 advantages. Weaker ideas are rejected earlier, and stronger ideas can be held with greater confidence when temporary volatility arrives. Ink is cheap, unexamined conviction is not. Law 8. Let patience become an active strategy. The ability to wait without becoming careless is a competitive advantage. A farmer does not improve a harvest by pulling on the plants. Capital markets encourage constant movement because activity generates fees, attention, and the feeling of control. Yet many of the finest investment results come from long periods during which the visible action is minimal. The research was completed, the asset was purchased, and the compounding process was allowed to work. Patience is frequently misunderstood as passivity. Real patience is active. It includes monitoring, learning, updating, and preserving liquidity. It refuses unnecessary action while remaining ready for necessary action. 3 forms of waiting. The first is pre-investment patience. The investor studies a strong asset but refuses to pay a price that leaves no margin. He builds knowledge before opportunity arrives. When fear eventually creates a suitable price, execution can be fast because preparation was slow. The second is ownership patience. A good business needs time to reinvest, strengthen customer relationships, expand distribution, and convert small advantages into large outcomes. Interrupting the process because of ordinary price movement can destroy the benefit of long-duration ownership. The third is recovery patience. Distressed assets, restructurings, and cyclical industries may require time for balance sheets, inventories, and demand to normalize. This form is dangerous unless survival is secure. Waiting cannot repair a company that runs out of cash. Patience versus inertia. The patient investor remains because the thesis is intact. The inert investor remains because deciding is uncomfortable. Ask what evidence would justify continued ownership. If the answer is merely, the price may come back, patience has become avoidance. A deteriorating asset often asks for more patience at precisely the moment when decisive action is needed. Management promises another quarter. The integration is almost complete. The turnaround is just beginning. The investor must distinguish delay in value recognition from delay in admitting failure. The cash option cash usually offers a lower visible return than risky assets during expansion. That makes it emotionally difficult to hold. But cash contains an embedded option, the right to act when prices become attractive and other investors are constrained. David Tepper's distress style illustrates the value of liquidity during fear. Exceptional opportunities often appear when institutions must sell for reasons unrelated to long-term value. The buyer who arrives with cash, courage, and knowledge receives terms unavailable in calm markets. Cash is not automatically wise. Excess cash held for years without a plan can become a drag. Its value depends on the probability of future opportunity, the investor's discipline, and the availability of acceptable alternatives. The cost of constant activity. Every transaction creates friction. Spreads, taxes, fees, slippage, research time, and the risk of replacing a known asset with an unknown one. Frequent movement also increases exposure to emotional errors. An investor who trades from boredom must be right about two decisions: the asset sold and the asset purchased. The hurdle is higher than it appears. Long-term ownership does not mean ignoring valuation. A wonderful business can become so expensive that future returns are weak. The point is to require a meaningful reason before interrupting a successful compounding relationship. Building a prepared watch list patience becomes productive when paired with readiness. Maintain a list of businesses, securities, properties, or industries you understand. For each, record the economics, key risks, normalized earning power, balance sheet quality, and price range that would justify action. Update the work periodically. When markets decline, you will not need to begin research in a state of panic. You will be choosing from prepared ideas. This is how patience becomes speed. The waiting checklist before doing nothing confirmed that the thesis remains supported by evidence. The balance sheet can survive the expected period. The position is not creating forced liquidity needs. Management continues to allocate capital rationally. Opportunity cost remains acceptable. The expected return from today's price is still attractive. Waiting is a decision, not an excuse. Final principle in markets: action is visible and patience is invisible. Visibility should not be confused with value. The sophisticated investor can spend months doing research, years holding an asset, and minutes acting when the conditions finally align. He understands that waiting is not the absence of a strategy. Sometimes, waiting is the strategy. Law 9. Price is what the crowd agrees upon. Value is what the asset produces. A quotation is an opinion. Value is an economic relationship. At 9:30 in the morning, a public company may be valued at $10 billion. By noon, after an analyst downgrade and a wave of selling, the quoted value may be $8 billion. The factories, customers, patents, employees, contracts, and inventory did not change by 20% in 2.5 hours. What changed was the price at which buyers and sellers were willing to exchange ownership. Price is visible, immediate, and precise. Value is estimated, uncertain, and dependent on future cash flows. This difference makes price psychologically powerful. Investors can see it every second, while value must be reasoned from incomplete evidence. Intrinsic value is a range. Intrinsic value is not a secret number hidden inside a company. It is an estimate of the present worth of future economic benefits available to owners. Those benefits depend on revenue, margins, taxes, reinvestment, competition, management, financing, and time. Small changes in assumptions can alter the estimate materially. An honest valuation, therefore, produces a range rather than a point. A range also disciplines language. Instead of saying, the company is worth exactly $52, the investor may conclude that conservative value lies between 45 and 60, with the width reflecting uncertainty. A purchase at 35 offers a different proposition from a purchase at 58. The components of value 4 elements deserve particular attention. First is earning power, the normalized cash the asset can generate under ordinary conditions. Second is reinvestment, the return available on capital retained inside the business. Third is duration, the number of years those attractive economics can persist before competition erodes them. Fourth is risk, the probability that debt, disruption, regulation, fraud, or poor allocation prevents the expected cash from reaching owners. A high-growth company may have little value if growth consumes more capital than it creates. A slow-growing company may be valuable if it produces abundant cash and distributes it wisely. A distressed bond may be attractive even when the issuer is weak if the recovery value exceeds the purchase price by a wide margin. Relative valuation and its trap investors often compare a company with peers. If similar businesses trade at 15 times earnings and one trades at 10, the cheaper company appears attractive. Relative valuation is useful for understanding market expectations, but it can spread a common error. If the entire industry is overpriced, the least expensive member may still be expensive. If accounting quality differs, the multiples may not be comparable. If one company requires heavy capital investment while another converts earnings into cash, identical multiples do not imply identical value. A multiple is the result of underlying economics, not a substitute for studying them. Private market price in private acquisitions. Price is negotiated rather than continuously quoted. That does not make it more rational. A seller may anchor to a recent transaction, a broker's estimate, or the amount needed for retirement. A buyer may justify a high price through synergies, leverage, or optimism. Auctions create social proof. The presence of several bidders can be mistaken for evidence of value when it merely demonstrates competition. The disciplined buyer establishes a walkaway price before the final emotional stage. The value of ownership must exceed not only the purchase price, but also transaction costs, integration investment, working capital, and the opportunity cost of management attention. What Buffett's framework teaches Warren Buffett's approach is often summarized as buying excellent businesses at fair prices. The deeper lesson is to think like an owner of the entire enterprise. If the stock market closed for years, would the company still be attractive based on the cash it could produce and reinvest? This question removes the comforting assumption that a future buyer will pay more.
It directs attention to the asset itself.
Evaluation discipline before purchasing. Answer: what normalized cash flow belongs to owners? How much capital must be reinvested to protect that cash flow? What growth can be achieved without weakening returns? How long can competitive advantages persist? What claims stand ahead of common equity? Which assumptions drive most of the value? What return is implied by today's price? How much error can the purchase price absorb? Then calculate the result under less favorable assumptions. If modest disappointment destroys the return, the price offers little protection. Final principle. The market can quote an asset without understanding it. Your responsibility is not to accept or reject the quote emotionally. It is to compare the quote with a reasoned estimate of future economic benefit. Price tells you what the crowd will accept today. Value asks what the asset can deliver over time. Never confuse the ease of observing one with the difficulty of estimating the other. Law 10. Follow the cash, not the performance. Accounting profit is a claim. Cash conversion is the test. A company reports record earnings. The chief executive celebrates operating momentum. The presentation shows adjusted profit rising faster than revenue. Yet the bank account is weaker. Receivables have grown because customers are paying later. Inventory has accumulated. Equipment requires replacement. Several expenses have been capitalized rather than recognized immediately. The business appears more profitable while consuming more cash.
This is not an accounting trick in every case.
Growth often requires working capital. Long-lived assets should sometimes be capitalized. The danger lies in assuming that reported earnings and owner economics are identical. The cash bridge start with operating profit and build a bridge to free cash flow. Add non-cash expenses such as depreciation, but do not stop there. Subtract cash taxes. Account for changes in receivables, inventory, payables, and customer deposits. Subtract capital expenditures required to maintain the asset base. Include recurring restructuring, lease obligations, and other cash needs that adjusted earnings may exclude. The result is not always simple, but the discipline reveals where profit becomes trapped. A business can grow earnings while destroying liquidity if each additional dollar of revenue requires large inventory, long payment terms, or expensive equipment. Maintenance versus growth investment capital expenditure is often divided into maintenance and growth. The distinction matters because owner earnings should subtract what is required to preserve current earning power. Management has an incentive to label spending as growth. The investor should ask what happens if the expenditure is not made. If machinery fails, software becomes obsolete. Safety declines, stores deteriorate, or customer service weakens. The investment is partly maintenance regardless of its label. A company can temporarily increase free cash flow by underinvesting. The cash is real, but it may represent the consumption of future capability. Working capital as a hidden use of funds. A profitable sale does not create usable cash until the customer pays. Rapid growth can therefore create a financing problem. Imagine a distributor earning a healthy margin, but paying suppliers in 30 days while customers pay in 90. Each new order requires cash for 2 months. Growth can push the company toward insolvency even while the income statement improves. The opposite can be powerful. Subscription businesses, insurers, and certain retailers receive cash before recognizing revenue or paying suppliers. Their customers help finance operations. Cash timing is part of the business model. Adjusted earnings adjustments can be legitimate when they isolate unusual events. The warning sign is the permanently recurring one-time expense. If restructuring occurs every year, restructuring may be part of normal operations. If acquisition costs recur because acquisitions are the strategy, they belong in the economics. If stock compensation is required to retain employees, it represents a transfer of ownership even though no cash leaves immediately. The investor should not ask whether an expense can technically be excluded. Ask whether the company must bear the cost repeatedly to compete and operate. Owner earnings, a practical owner earnings estimate, begins with operating cash flow, subtracts maintenance capital expenditure, and adjusts for unusual working capital movements and recurring obligations. For a private company, normalize owner compensation, related party rent, personal expenses, deferred maintenance, and family payroll. The purpose is not to create the highest possible number. It is to estimate the cash a rational owner could extract without weakening the enterprise. A quality of earnings review examined 5 relationships: earnings growth versus operating cash flow growth, revenue growth versus receivables growth, cost of goods sold versus inventory growth, depreciation versus capital expenditure, adjusted earnings versus the frequency of adjustments. Persistent divergence deserve explanation. Final principal profit can be presented. Cash must eventually appear. A sophisticated investor follows the movement of money through the business, identifies what is required to maintain earning power, and refuses to treat accounting performance as owner wealth until conversion is demonstrated. Cash is not the only measure of value, but it is the place where financial stories eventually meet economic reality. The economic engine. Every company should be reducible to a plain language explanation of how money enters, where it is spent, and why anything remains. Who is the customer? What problem is solved? Why does the customer choose this provider? How often does the purchase occur? What determines price? Which costs rise with volume? Which costs remain fixed? What capital is required before revenue appears? Who controls distribution? What could make the product irrelevant? If the answer relies on fashionable terminology, simplify further. A business that cannot be explained may still be excellent. It is simply outside the investor's circle of competence. Revenue is not one thing. A company may report one revenue number while containing several economic streams. Contracted recurring revenue has different value from one-time projects. High-margin software licenses differ from low-margin implementation services. A retailer's same-store growth differs from revenue created by opening new locations. A manufacturer selling replacement parts may have better economics than the original equipment line. Break revenue into components and ask what drives each one. Cost structure. Understanding fixed and variable costs helps estimate operating leverage. A company with high fixed costs may produce rapid margin improvement as volume rises, but the same structure creates severe pressure when demand falls. A labor-intensive service business may adjust costs faster, but struggle with wage inflation. A marketplace may appear capital light while spending heavily to acquire users. The income statement should be read as a map of operational behavior, not a list of percentages. Industry structure. A good company can be trapped in a bad industry. If customers have bargaining power, suppliers control critical inputs, competitors can enter easily, and products are undifferentiated, attractive returns invite competition and disappear. Conversely, a seemingly ordinary business may benefit from local density, regulation, switching costs, or distribution relationships that protect economics. Study how profit is divided across the value chain. The company with the most visible brand may not capture the most value. Management's role. Some businesses can survive average management because the economics are powerful. Others require exceptional execution every year. The second category deserves a larger margin of safety. Ask whether the system produces results or whether one individual does. Founder dependence, sales concentration, technical knowledge, and capital allocation may all reside in the same person. That can create strength during ownership and risk during transition. The Peter Lynch test. Peter Lynch encouraged investors to understand what they own and why they own it. Everyday observation can reveal demand, customer satisfaction, and product momentum, but observation must connect to economics. A busy restaurant may be unprofitable. A popular store may have expensive leases. A useful app may acquire customers at a cost greater than their lifetime value. The story starts in the real world and ends in the financial statements. The Business Understanding Checklist. Before using a valuation multiple, write answers to these questions. What creates demand? What keeps the customer from leaving? Which input can damage margins? How much capital does growth require? What is the smallest repeatable economic unit? Which competitor is most dangerous and why? What is management uniquely good at? What part of the current profit may be temporary? What evidence would show that the business model is weakening? Final principle. A low multiple can signal opportunity, decay, cyclicality, leverage, or poor accounting quality. A high multiple can reflect durability, growth, scarcity, or enthusiasm. The number is the beginning of a question, not the end of analysis. Understand the machine before pricing its output. Law 12. Study the unit before you study the empire. Expansion multiplies the economics of the smallest repeatable unit. A chain announces plans to double its locations. Investors calculate revenue using the current average store and celebrate the growth runway. The missing question is whether the newest stores resemble the mature ones. Older locations may occupy the best markets, benefit from established customer habits, and require less promotional spending. New units may open in weaker territories, cannibalize existing sales, and demand higher labor costs. Total revenue rises while return on each new dollar falls. The empire can grow even as the unit deteriorates. Unit economics: the unit depends on the business. It may be a store, customer, route, salesperson, property, contract, loan, cohort, machine, or acquisition. For each unit, measure the capital required: revenue generated, gross profit, operating cost, retention, payback period, and lifetime value. Then examine how those figures change across time and geography. Averages can conceal weakness. If old customers are highly profitable and new customers are uneconomic, the blended number may look healthy until growth slows. Customer acquisition digital businesses often focus on customer acquisition cost and lifetime value. These measures are useful only when calculated honestly. Acquisition cost should include the full sales and marketing burden, not merely direct advertising. Lifetime value should reflect churn, servicing cost, discounts, refunds, and the time value of money. A customer who produces cash over 5 years is not equivalent to one who pays up front. If the model requires lifetime value estimates far beyond observed history, confidence should decline. Route density and local advantage. In service businesses, the unit may be a route or crew. A roofing contractor, pest control company, waste collector, or home services operator can improve economics through geographic density. Travel time falls, scheduling improves, referrals increase, and supervision becomes easier. Expanding into a distant market may increase revenue while destroying density. The company gains a map pin and loses efficiency. Growth should be evaluated at the operational level where work occurs. Acquisitions as units a serial acquirer should be studied deal by deal. What multiple was paid? How much additional capital was required? Which managers remained? How quickly were systems integrated? What return was produced after all costs? Headline growth can hide declining acquisition quality. Early deals may have been proprietary and inexpensive. Later deals may occur in competitive auctions. The platform becomes larger while incremental returns fall. Constellation Software and other disciplined acquirers are admired not simply for buying many companies, but for maintaining a process that seeks acceptable returns across repeated decisions. The cohort analysis group units by the period in which they began. Compare customers acquired this year with those acquired 3 years ago. Compare recent stores with the first wave. Compare loans originated under different underwriting standards. Cohorts reveal whether growth quality is improving or deteriorating. A lender may report stable average defaults while newer loan vintages weaken. A subscription company may show total revenue growth while recent customer churn rises. The future is often visible first in the newest cohort. The unit scorecard. For the smallest repeatable unit, track initial capital or acquisition cost, time to cash break-even, mature revenue and margin, retention or repeat rate, incremental working capital, maintenance investment, sensitivity to volume and price, managerial attention required, evidence of saturation or cannibalization. The company deserves a premium valuation only if it can reproduce attractive units without exhausting markets or degrading quality. Final principle. A grand strategy can make weak economics sound important. A map of future locations can create the appearance of destiny. The disciplined investor returns to the unit. If each additional unit creates value, expansion can become a compounding engine. If each unit destroys value, scale only makes the mistake larger. Study the brick before admiring the building. Law 13. Demand a margin of safety. The investment should not require perfection to succeed. A bridge is not designed merely to support the expected weight of ordinary traffic. Engineers include capacity for uncertainty, heavier loads, weather, material variation, and errors in estimation. Capital deserves the same respect. An investment model may assume reasonable growth, stable margins, available financing, and a normal exit. Each assumption can be individually defensible while the combination leaves no room for ordinary disappointment. A margin of safety is the space between what must go right and what can go wrong. Price is protection. The most familiar margin of safety is price. Buying below a conservative estimate of value reduces the loss created by analytical error and increases the return if the thesis works. But price is not the only protection. A strong balance sheet creates time. Recurring revenue creates visibility. Diversified customers reduce dependence. Tangible collateral can support recovery. Conservative position size protects the portfolio. Contractual protections improve creditor outcomes. Operational control may allow a private owner to influence results. Margins of safety can be structural as well as numerical. Conservative assumptions. A model becomes dangerous when every line contains optimism. Revenue grows faster than the market. Margins rise. Capital expenditure remains low. Working capital improves. The exit multiple stays high. Use assumptions that can survive contact with ordinary reality. Separate what management controls from what the market controls. Give no credit for multiple expansion. Require the business to create the return. If the investment remains attractive after reducing growth, delaying improvement, and increasing required capital, the foundation is stronger. False safety, a low price alone, does not guarantee protection. A declining business can remain cheap all the way to insolvency. Book value may contain obsolete inventory, uncollectible receivables, or assets that cannot be sold near carrying value. A high dividend may be funded by debt. Safety must be linked to realizable economic value and survival. The same applies to diversification. Owning many similar assets may feel safe while exposing the portfolio to one common shock. Distressed investing David Tepper became known for buying securities during periods of severe fear. The opportunity in distress often comes from a gap between quoted price and probable recovery value. This work requires understanding the capital structure. Which claim is senior? What collateral exists? How much cash is consumed before restructuring? What legal rights protect the investor? What value remains after administrative costs and competing claims? A large discount to face value may still provide no margin if recovery is lower. The acquisition buffer in a private transaction include buffers for integration cost, working capital, management replacement, customer loss, and delayed synergies. Do not use every available dollar at closing. An undercapitalized buyer can turn a good business into a distressed one. Seller financing, earnouts, escrows, and contingent payments can shift risk when used honestly. Structure cannot repair an excessive price, but it can align payment with realized performance. The error budget asks, how many assumptions can disappoint before the expected return falls below acceptable levels? If one missed quarter breaks the thesis, the error budget is tiny. If the company can lose a customer, face a recession, and still service debt while protecting long-term value, the investment has resilience. The size of the error budget should influence position size. Final principle, a margin of safety is humility expressed in financial terms. It acknowledges that forecasts will be imperfect, people will disappoint, and the world will produce events the model did not anticipate. The sophisticated investor does not ask for certainty. He asks for enough room to be wrong without being ruined. Law 14. Respect the balance sheet. The income statement explains performance. The balance sheet determines endurance. A company can operate well and still fail because its obligations arrive before its opportunities mature. During favorable conditions, debt appears cooperative. Lenders refinance. Interest is manageable. Asset values rise. Management begins to treat capital availability as a permanent feature of the business model. Then the cycle changes. Cash flow weakens. Collateral values fall. Covenants tighten. The company discovers that the calendar, not the long-term thesis, controls claims before equity. Common shareholders own the residual after employees, suppliers, tax authorities, landlords, lenders, and other claimants are paid. A business may possess valuable assets while equity is worth little because senior claims absorb the value. Study the entire capital structure. Identify secured debt, unsecured debt, leases, preferred stock, pensions, litigation, guarantees, and off-balance sheet commitments. The location of a claim matters. Debt at a holding company may have different access to operating cash than debt at a subsidiary. Maturity is a risk variable. A company with long-dated fixed-rate debt may survive a temporary decline that destroys a similar company dependent on short-term refinancing. Create a maturity schedule. Compare each year's obligations with expected cash generation and available liquidity. Ask what happens if credit markets close for 12 or 24 months. A refinancing assumption is not the same as repayment capacity. Interest coverage ratios should be tested under normalized and stressed earnings. High current coverage may reflect peak margins. Floating rate debt may become more expensive at the same time earnings weaken. Use cash interest, not a convenient accounting measure. Include required amortization and recurring lease obligations. The company must fund the entire burden. Asset quality assets are not equally useful. Cash is liquid but may be trapped in foreign subsidiaries. Receivables may be concentrated among weak customers. Inventory may become obsolete. Property may carry environmental liabilities. Goodwill cannot pay a lender. Book value is a starting point. Recovery value requires judgment. Hidden leverage can appear through leases, purchase commitments, supplier financing, derivatives, guarantees, and minimum agreements. A company that outsources assets may look capital light while retaining fixed obligations. At the investor level, hidden leverage appears when several holdings depend on the same financing condition. A portfolio may contain little explicit debt yet be highly exposed to rising rates, falling property values, or disappearing liquidity. Ray Dalio and the economic machine Ray Dalio's framework emphasizes the interaction of credit, spending, and cycles. Debt allows spending to exceed income in the present, but future income must service the obligation. At scale, this creates cycles of expansion and contraction. For the individual company, the lesson is direct. Leverage pulls future cash requirements into today's decision. It can accelerate wealth when returns exceed cost and conditions remain supportive. It can remove choice when conditions deteriorate. The balance sheet stress test model, a scenario with revenue down 20%, margin compression, higher interest rates, slower customer payments, no access to new debt, reduced asset sale proceeds. Then ask whether the company can meet obligations without issuing equity at a distressed price. If survival depends on a generous lender, the lender is the true owner of the timetable. Final principle. A strong income statement can attract investors. A strong balance sheet allows the business to remain alive long enough to deserve them. Respect debt, maturity, liquidity, and claim priority. The best investment thesis in the world has no value if the capital structure removes the time required for it to become true. Law 15. Search for pricing power. The ability to raise price without destroying demand is one of the purest forms of business quality. Inflation enters quietly. Wages rise. Suppliers increase prices. Insurance costs more. Rent resets. A company without pricing power watches margins compress while managers debate which cost to cut. Another company raises prices by 4%. Customers remain. The increase flows through revenue with little additional capital. The second company owns an economic advantage that financial statements may understate. Measuring the reality management often claims pricing power after raising list prices. The investor should examine realized price after discounts, mix, churn, and volume changes. If a company raises price 5% but loses its best customers, the economics may weaken. If price increases merely offset product inflation, gross margin may not improve. If salespeople grant concessions, list price becomes irrelevant. Track retention, unit volume, customer complaints, contract renewals, and competitive response. Price versus value. Sustainable pricing power is not the ability to exploit customers. It is the ability to capture a reasonable share of value created. A company that continually raises price without improving value may invite competition or resentment. The strongest businesses invest in service, reliability, convenience, innovation, and brand, while pricing below the economic benefit delivered. That creates room for increases without breaking trust. Main Street application small businesses often underprice because owners fear customer reaction or lack data. A service company may charge one rate across customers with very different complexity, urgency, and travel requirements. Profit disappears through invisible exceptions. A disciplined pricing review examines job-level profitability, minimum charges, travel time, material volatility, rush service, warranty risk, and customer segments. Not every customer deserves the same structure. The goal is not to raise every price. It is to align price with cost, risk, and value. Brand and habit. Some consumer companies possess pricing power because buying has become habitual, but habit can be fragile if quality falls or alternatives improve. A premium valuation should require evidence that brand preference survives price changes across cycles, not merely during a strong demand. Buffett's preference. Warren Buffett has repeatedly emphasized businesses able to raise prices without requiring large additional capital. The appeal is mathematical. A modest price increase across a large revenue base can produce substantial incremental profit. Pricing power also protects real returns during inflation. Companies that must absorb every cost increase transfer wealth from owners to customers. The pricing power audit ask: When was the last price increase? What happened to unit volume and retention? Are discounts increasing? How quickly do contracts reset? Does the customer measure value or merely compare price? What is the cost of switching? Which competitor can undercut the company? Does price reflect superior value or temporary shortage? Final principle: growth can require new people, facilities, inventory, and risk. Pricing power can create additional earnings from an existing base. The sophisticated investor searches for businesses that earn the right to charge more because customers would lose more by leaving. Law 16. Value the reinvestment runway. A high return becomes extraordinary when it can be repeated for a long time. A company earns 30% on capital but can invest only a small amount before saturating its market. Another earns 18% and can reinvest nearly all of its cash for 20 years. The first business may produce excellent current economics. The second may create greater lifetime wealth. Compounding depends on both rate and duration. Return on incremental capital. Historical return on capital describes what the existing business achieved. What the next dollar can earn. A mature company may display exceptional average returns because old assets were acquired cheaply, while new projects produce mediocre results. A younger company may show modest current margins while investing in infrastructure that supports high future returns. Study incremental economics. Compare the capital added over several years with the change in normalized operating profit. The Runway A reinvestment runway may come from new locations, geographic expansion, adjacent products, digital distribution, customer growth, price acquisitions, or deeper penetration of an existing market. The runway must be both large and accessible. A theoretical global market is not useful if the company lacks distribution, management, capital, or customer permission to enter it. A credible runway has evidence: successful pilot locations, repeatable unit economics, low churn, improving returns, and management capable of scaling without losing culture. Internal versus external reinvestment. Internal reinvestment funds the existing business. External reinvestment acquires other businesses or assets. Internal opportunities are often safer because management understands the economics, but they can still destroy value if expansion outruns demand. Acquisitions can extend a runway when organic markets mature, but they introduce price integration and cultural risk. The discipline of the buyer matters as much as the quality of the targets. Capital-light compounding. Some businesses can grow without proportional capital. Software, marketplaces, data, and certain service models may add customers at low incremental cost. Customer acquisition, research, talent, and infrastructure may be expensed rather than capitalized. The investor must identify the real economic investment regardless of accounting classification. Dividends and repurchases. When attractive reinvestment opportunities disappear, management should return capital rather than pursue empire building. Dividends provide direct distribution. Share repurchases can create value when shares are bought below intrinsic value and when repurchases exceed dilution. Both are rational responses to a shortening runway. The failure is retaining capital simply because management prefers a larger company. A long-duration example: a retailer with strong store economics may have years of expansion before reaching market saturation. Early in the runway, retained earnings deserve a high value because each new store creates attractive returns. As the network matures, the same company should shift toward productivity, pricing, and capital returns. The valuation should change with the runway, even if the current income statement remains strong. Runway questions: how much capital can be reinvested at attractive rates? What evidence shows the opportunity is repeatable? Which market becomes saturated first? Do incremental returns rise or fall with scale? What managerial capability limits expansion? How much of growth depends on acquisitions? What will management do when the runway narrows? Final principle: a great business is not merely one that earns high returns today. It is one that can deploy meaningful capital at attractive rates tomorrow without weakening the advantages that created the return. Rate starts the engine. Duration creates the distance. Law 17. Invest in capital allocators, not merely operators. The future of shareholder wealth is shaped by what management does with the next dollar. A chief executive can run factories efficiently, motivate sales teams, improve customer service, and still destroy enormous value. Operational excellence creates cash. Capital allocation decides where that cash goes. The choices are limited but consequential. Management can reinvest in the core business, acquire another company, repay debt, repurchase shares, pay dividends, build liquidity. or pursue a new venture. Every choice competes with the others. A dollar used for an acquisition cannot also reduce debt. A dollar retained at a low return could have been distributed to owners. The sophisticated investor therefore evaluates management in two roles: operator and allocator. The reinvestment test. The first question is whether the core business can absorb capital at attractive incremental returns. If new capacity, locations, software, research, or customer acquisition produces high returns, reinvestment is sensible. If the business is mature, forcing capital into expansion can reduce value. Management may prefer growth because larger organizations bring status, compensation, and strategic importance. Shareholders care about value per share, not managerial prestige. Reinvestment should be measured after all capital required, including working capital, supporting systems, and management attention. Acquisitions and acquisition should be judged like any other investment. What is the total purchase price? What additional capital will integration require? Which synergies are controllable? What return is expected under conservative assumptions? What alternatives were available? Executives often describe acquisitions using strategic language that avoids arithmetic. The target is transformational, platform-defining, or immediately accretive. Earnings accretion can be created through cheap debt even when the return on invested capital is poor. The relevant question is not whether earnings per share rise next year. It is whether the value of each share increases after considering price, risk, integration, and dilution. Debt reduction repaying debt creates a predictable return equal to the after-tax cost avoided while reducing financial risk. In a highly leveraged company, debt reduction may be the most valuable use of cash even when it appears unexciting. The benefit includes optionality. A stronger balance sheet can fund future acquisitions, survive downturns, and avoid issuing equity at a distressed price. Repurchases buying back shares can create substantial value when the stock trades below intrinsic value and the company retains adequate liquidity. It destroys value when management repurchases expensive shares to offset dilution, support short-term earnings, or meet compensation targets. A repurchase is an investment in the company's own equity. It deserves the same valuation discipline as an external acquisition. Dividends are appropriate when shareholders can allocate capital better than the company. A mature business with stable cash flow and limited reinvestment opportunities should not hoard capital merely to preserve an image of growth. The investor should examine whether the dividend is funded by genuine free cash flow. Debt finance distributions can weaken the enterprise while creating a temporary appearance of generosity. The Berkshire lesson Berkshire Hathaway became a case study in capital allocation because it could move cash among wholly owned businesses, public securities, acquisitions, and liquidity reserves. The advantage was not a single asset. It was the ability to compare opportunities across a broad field and wait when prices were unattractive. The lesson for smaller investors is not to imitate Berkshire's portfolio. It is to rank uses of capital rather than treating each business unit, asset class, or executive proposal as entitled to funding. The allocation scorecard for every major use of capital record: amount invested, expected return, expected time to cash generation, principal downside, actual result after 1, 3, and 5 years, comparison with the cost of capital, comparison with alternatives available at the time. Management teams should be judged not only on decisions made, but on the discipline to reject weak proposals. Final principle: a company can be excellent at making money and poor at keeping it productive. Study where the cash goes. The next dollar, not the last quarter, often reveals whether management is building shareholder wealth or financing ambition. Law 18. Incentives reveal the hidden strategy. Corporate statements describe intentions. Compensation systems reveal priorities. A bank tells investors that risk management is central. Its senior lenders are paid almost entirely for loan growth. A retailer speaks about customer loyalty while store managers are rewarded for pushing high-margin warranties customers do not need. A public company celebrates long-term value while executives receive bonuses for annual adjusted earnings. Behavior follows incentives more faithfully than speeches. What gets rewarded gets repeated. Incentives do not need to be malicious to create destructive behavior. A target can be reasonable in isolation and dangerous in context. Revenue growth encourages sales, but may also encourage discounting and weak customers. EBITDA targets encourage efficiency, but may add to deferred maintenance or underinvestment. Earnings per share targets may encourage debt-funded repurchases. Assets under management targets can reward fundraising even when opportunity is scarce. The measurement becomes the strategy when compensation depends on it. Short-term metrics and long-term assets. Many investments require years to mature. Research, brand building, employee development, new locations, and customer relationships may reduce current earnings before creating value. If management is paid on one-year results, it may underinvest in projects whose benefits arrive after the compensation period. The company appears efficient while future capability erodes. A stronger design combines current operating discipline with multi-year value creation. Measures can include return on invested capital, cash conversion, customer retention, safety, product quality, and per-share value. Equity compensation equity can align managers with owners, but only when the design is thoughtful. Options may encourage risk because the upside belongs to the manager, while much of the downside belongs to shareholders. Restricted stock may reward market-wide appreciation unrelated to performance. Large grants can dilute owners even when presented as non-cash expense. Vesting periods, performance hurdles, ownership requirements, and clawbacks influence behavior. A manager who must hold meaningful equity after retirement may think differently from one who can sell immediately after vesting. Private equity and management ownership, private equity sponsors frequently ask management to invest alongside the fund. This can create strong alignment because managers share both upside and downside. Yet alignment is incomplete if the sponsor controls leverage, acquisitions, fees, and exit timing. Management may also focus on the metric that maximizes the transaction value at exit, while underinvesting beyond the hold period. The investor should examine the entire agreement, not merely the percentage owned. Incentives in advice, financial advisors, brokers, bankers, fund sponsors, and consultants have compensation structures that shape recommendations. A product paying a larger commission may receive more attention. A banker paid when a deal closes is not economically neutral about closing. A manager charging fees on committed capital may feel pressure different from one earning primarily on performance. This does not make the advice useless. It means the incentive belongs inside the analysis. The incentive map before investing map the important parties. What action creates their compensation? What happens if the investment fails? How much personal capital is exposed? When can they realize gains? Which costs are borne by others? What behavior could improve the metric while harming long-term value? Who has authority to challenge the system? Incentives can also be cultural. Promotions, status, praise, and access may matter as much as money. A Main Street example. A service company pays technicians based on the number of jobs completed. Productivity rises, but callbacks and customer complaints increase. Management changes the plan to include quality, repeat visits, safety, and customer retention. The Horizon. The lesson applies to boards and portfolios. Measurement architecture is operating architecture. Final principle: when words and rewards disagree, trust the rewards. The sophisticated investor asks not only whether people are capable and honest, but what the system makes rational for them to do. Incentives do not predict every action. They reveal the direction of pressure. Law 19. Judge management by per-share value. A company can become larger while each owner becomes poorer. Executives celebrate total revenue, total assets, total employees, and total earnings. These figures may reflect progress, but shareholders own fractions of the enterprise. If growth requires issuing shares faster than value is created, the company expands while ownership is diluted. If acquisitions increase total earnings but produce returns below the capital used, the organization becomes larger and less valuable per dollar invested. The correct unit is value per share. The denominator matters. Earnings per share can rise for several reasons. The business may earn more. The company may repurchase shares. Interest costs may fall. Accounting adjustments may improve the numerator. Each has different quality. Likewise, total earnings can rise while earnings per share stagnate because stock compensation or acquisition currency expands the share count. Track diluted shares over time. Compare repurchases with new issuance. A company may announce a large buyback while merely offsetting employee grants. Acquisition accretion: a company trading at 20 times earnings can buy a slower growing company at 10 times earnings and report immediate earnings accretion. That arithmetic does not prove value creation. The acquirer may have issued expensive shares, which can be rational, but it may also inherit weak assets, integration risk, and low returns. The transaction should be evaluated through intrinsic value per share, not the first-year accounting effect. Accretion is a calculation. Value creation is an economic outcome. Debt and the per-share illusion borrowing to repurchase stock can increase earnings per share because fewer shares divide the earnings. If the stock is overpriced or the debt weakens resilience, the apparent improvement may conceal value destruction. The investor must account for the claim added to the capital structure. Equity holders own a smaller share count, but also a more leveraged residual. Owner-oriented reporting management teams that think like owners often discuss per-share results, capital employed, cash conversion, and long-term returns. They explain dilution and avoid celebrating growth without cost. The tone of communication matters. Does management compare actual results with prior promises? Are failed projects discussed? Are acquisition returns disclosed after closing? Are metrics changed when performance weakens? Candor is part of governance. A private company equivalent in a private partnership, the same principle appears as value per ownership unit. New investors, option pools, earnouts, and rollover equity change the denominator. A founder may retain a smaller percentage of a much larger company and become wealthier. Dilution is not automatically bad. The question is whether the capital raised or equity issued creates more value than the ownership surrendered. Per share value drivers monitor. Normalized free cash flow per diluted share. Revenue and gross profit per share. Net debt per share. Invested capital per share. Share issuance and repurchases. Value of acquisitions relative to shares issued. Long-term growth in intrinsic value per share. No single metric is perfect. Together they force attention toward the owner's unit. Final principle corporate scale can be impressive and economically irrelevant. Shareholders do not own the press release, the headquarters, or the total revenue. They own a claim on the enterprise divided by every other claim. Ask whether each share is becoming more valuable. Everything else is supporting detail. Law 20. Favor durability over excitement. The value of an advantage depends on how long it can resist erosion. Excitement attracts capital because the future appears open. A new technology, category, or consumer behavior can create extraordinary businesses. It can also attract competitors, generous financing, and unrealistic prices. Durability is quieter. It appears in repeat customers, embedded workflows, regulatory licenses, distribution density, trusted brands, low costs, and operational habits built over years. The sophisticated investor asks not only how fast the company can grow, but why the returns will still exist after competitors notice them. The reinvestment required to defend the moat competitive strength often requires continued spending. A consumer brand needs product quality and marketing. A software platform needs security and development. A distributor needs inventory, logistics, and service. A low-cost producer needs efficient equipment. An apparent moat that depends on chronic underinvestment is weakening beneath reported profit. The investor should distinguish maintenance of the advantage from growth beyond it. Customer behavior durability is visible in customer choices. How long do customers remain? What causes departure? How difficult is implementation? Does the product occupy a small part of the customer's budget while supporting a critical function? Are renewals automatic or actively reconsidered? Does a competitor win by lowering price or by improving value? Customer interviews often reveal more than management adjectives. Disruption risk. The strongest incumbent can be vulnerable when technology changes the basis of competition. A company may dominate the old distribution channel while the new one grows outside its control. Study who benefits from change. Does the company possess the data, customer access, capital, and culture to adapt? Or does innovation threaten the source of current profit? Disruption is not merely the appearance of a new technology. It is a change in economics that weakens the incumbent's advantage. Excitement and valuation. Even a durable company can be a poor investment at an extreme price. When investors identify quality, they may bid away the future return. The proper combination is durability and valuation. A weaker business purchased cheaply may offer a good finite return. A durable compounder purchased reasonably may offer decades. The investor should know which game is being played. Costco, customer trust, and shared value businesses, such as Costco, have demonstrated how customer loyalty can be strengthened by sharing economics rather than extracting every available dollar. Low markups, membership, and operational discipline create a relationship that competitors cannot copy through advertising alone. The broader lesson is that durability often rests on repeated proof that the company deserves trust. The durability test asks, why has competition not already eliminated excess returns? Which customer behavior proves the advantage? What investment is required to maintain it? Who is most capable of attacking it? How would the company respond to a 10% price cut from a rival? Which technological or regulatory change could shorten the advantage? Does management protect the moat or monetize it too aggressively? Final principle: rapid growth can attract attention. Durable economics attract time, and time is the essential ingredient of compounding. Prefer advantages that deepen through use, trust, scale, learning, or habit. Excitement may begin a story. Durability determines how many chapters it can survive. Law 21. Growth is valuable only when its returns are valuable. Expansion creates wealth only when the return on the required capital exceeds its cost and risk. Revenue growth is easy to celebrate. It appears at the top of the income statement and fits neatly into headlines. The capital required to produce it is less visible. A company can add sales by discounting, extending credit, opening weak locations, buying competitors, or spending heavily on marketing. Each action may increase revenue while reducing value. Growth must be examined through return on incremental capital. The economics of the next dollar. Suppose a company invests $100 million in expansion and earns $5 million of additional annual after-tax operating profit. The 5% return may be below the company's cost of capital. The business is larger, but the investment destroyed value. Another company invests $20 million to produce the same $5 million. Its incremental return is far more attractive. The difference is not growth rate, it is capital productivity. Organic growth can come from price, volume, mix, new customers, new products, or new markets. Each source has different quality. Price growth may require little capital. Volume growth may require inventory and capacity. Product mix can improve margins. New markets may need management and distribution. Acquisition-driven growth adds purchase price and integration risk. Separate the components rather than treating all growth as equivalent. Growth in cash consumption, fast-growing companies can fail because working capital and investment absorb cash faster than financing arrives. The income statement may show success while the balance sheet becomes fragile. A disciplined growth plan includes funding. How much cash is required before the new revenue pays? What happens if customers pay later, costs rise, or demand develops more slowly? The company must survive the growth it seeks. The TAM seduction presentations often highlight a vast total addressable market. A large market does not guarantee value. The company may lack a profitable route to reach it. Competition may drive returns down. Customer acquisition may become more expensive as the easiest segments are exhausted. The relevant market is the portion the company can serve at attractive economics. Private equity growth plan sponsors frequently underwrite multiple expansion through operational growth. A credible plan identifies specific initiatives, required capital, accountable leaders, timing, and expected returns. A weak plan uses category labels: cross-selling, digital transformation, geographic expansion. The words sound strategic but lack operational ownership. Each initiative should be evaluated like a project with cash outflow, milestones, and a stop rule. Growth quality dashboard track, incremental revenue per dollar of capital, incremental operating profit. Cashback trend, customer retention by cohort, return on new locations or capacity, working capital demand, organic versus acquired growth. Share count and leverage used to fund expansion. If incremental returns fall consistently, growth is approaching saturation or execution is weakening. Final principle. A company does not create value by becoming larger. It creates value by investing capital at returns above the economic cost of that capital while preserving resilience. Growth is a tool. Return is the judgment. Law 22. Treat acquisitions as investments, not announcements. A strategic story cannot rescue an uneconomic purchase price. The day an acquisition is announced, the presentation is polished. Management describes complementary capabilities, cross-selling, scale, culture, and a larger addressable market. The benefits are quantified. The difficulties remain in footnotes. Years later, integration costs exceed estimates. Key employees depart, customers resist migration, and the expected synergies become longer-term opportunities. The applause occurs at signing. The economics arrive after closing. Why buyers overpay acquisitions create powerful psychological and institutional pressure. Executives want growth. Bankers earn fees. Boards fear missing a strategic asset. Competitors appear interested. Due diligence costs create commitment. The seller controls the process and often knows the business better than any bidder. Auctions convert caution into fear of loss. The buyer begins by asking what the target is worth and ends by asking what price will win. Winning the auction is not the objective. Earning an acceptable return is. Total invested cost purchase price is only the beginning. Add assumed debt, fees, retention payments, integration systems, working capital, restructuring, customer remediation, and management distraction. Then subtract realistic proceeds from asset sales or tax benefits. Use the resulting total capital to judge the return. A deal that appears inexpensive on headline EBITDA may be costly after required investment. Synergies fall into several categories. Cost synergies can be more controllable when they involve overlapping functions, procurement, facilities, or systems. Revenue synergies are less certain because customers make the final decision. Financing synergies can lower cost but may add leverage. Tax synergies depend on rules and structure. Do not pay the seller for value the buyer must create. The purchase price should leave a meaningful share of synergy with the acquirer's owners. Cultural integration culture is often dismissed as soft. It affects whether people share information, accept accountability, retain customers, and remain after closing. A decentralized acquirer may preserve local autonomy. A centralized platform may require system migration and standardization. Neither model is universally superior. Problems arise when the integration method conflicts with the source of the target's value. If customer relationships depend on local leaders, removing those leaders can destroy the asset purchased. Carl Icahn and the control question activist investors such as Carl Icahn have often focused on situations where assets may be valuable but poorly governed or allocated. Control, board influence, and strategic change can unlock value that passive ownership cannot. The lesson for acquisitions is that the buyer must know which changes are necessary and whether it has the authority and capability to implement them. Paying a control premium without a control plan is expensive symbolism. The deal post-mortem review every acquisition after 1, 3, and 5 years. Compare actual results with the original memo. Measure revenue retention, cost savings, integration spending, management turnover, cash conversion, and return on total capital. Avoid allowing the acquisition's results to disappear inside the larger company. Without postmortems, serial acquirers repeat mistakes while celebrating aggregate growth. Final principle. An acquisition is a capital allocation decision wrapped in a corporate event. Ignore the ceremony. Underwrite the asset, the people, the price, the structure, and the integration. The deal should create value even after enthusiasm is removed from the model. Law 23. Beware of businesses that must continually be rescued. New capital can postpone failure without repairing weak economics. Some businesses appear alive because investors continue to provide oxygen. Revenue grows. Product development continues. New locations open. Losses are explained as investment. Each financing round arrives at a higher valuation, which seems to validate the model. The company becomes skilled at raising capital before becoming skilled at producing it. When capital markets tighten, the business discovers whether customers or investors were truly financing the operation. The difference between investment and subsidy. Early-stage companies often lose money rationally while building products, distribution, or scale. The key question is whether each round of investment improves future unit economics and moves the company towards self-sufficiency. A subsidy maintains activity without changing the underlying return. If each new customer loses money before overhead, scale magnifies the loss. If growth requires permanent discounts, demand may be purchased rather than earned. The investor should look for a credible bridge from cash consumption to cash generation. Capital market dependence. A business is fragile when survival depends on raising money under favorable conditions. The risk is not only current burn rate, but the interaction between burn, runway, and market access. Calculate months of liquidity under a conservative plan. Assume the next financing takes longer, occurs at a lower valuation, or includes restrictive terms. Determine whether management can reduce spending without destroying the product or customer base. A runway measured to the optimistic financing date is not a runway. Mature rescue stories. Rescue dependence is not limited to startups. A mature company may refinance debt repeatedly, sell assets, issue shares, or rely on government support while core operations remain weak. Turnarounds can be excellent investments when the asset base, leadership, and structure create a path to recovery. The distinction is whether new capital funds a defined repair or merely covers recurring losses. The zombie company low interest rates and abundant liquidity can allow weak companies to survive for years. They service debt, but cannot invest enough to compete. Employees and customers remain, but productivity deteriorates. The apparent stability can mislead investors. When rates rise or a recession arrives, the lack of accumulated strength becomes visible. A rescue diagnostic asks, has gross margin improved with scale? Are customer cohorts becoming more profitable? Does cash burn decline relative to revenue? What milestone makes external financing optional? Can spending be reduced without collapsing demand? What happened after prior capital raises? Are proceeds funding growth, debt service, or old obligations? Most. Founder narratives. Charismatic founders can frame every loss as a sign of ambition. Vision matters, but vision should eventually produce economic evidence. A sophisticated investor respects innovation while demanding a financing plan. Belief in the mission does not remove the laws of cash. Final principle: capital can buy time. Time is valuable only when it is used to improve the economics. Do not confuse repeated rescue with resilience. A business that cannot live without the next investor is not yet an independent asset. It is a claim on future generosity. Law 24. Prefer optionality without paying for fantasy. Future possibilities are valuable when the present foundation is sound, and the price does not assume every possibility will succeed. Some companies own more than their current income statement reveals. A distribution network can support new products. A trusted brand can enter adjacent categories. Proprietary data can improve services. Excess land can be developed. A software platform can add modules at low cost. These possibilities are options. The market often struggles to value them because timing, investment, and probability are uncertain. That uncertainty can create opportunity. It can also create fantasy. Real options: a real option gives the company the right but not the obligation to pursue a future project. Management can wait for more information before committing full capital. A pharmaceutical pipeline, mineral reserve, unused manufacturing capacity, or international license may all contain option value. The current business supports the waiting period. The best optionality is financed by a durable core and acquired at little additional price. Narrative optionality appears when investors assign value to every imaginable market the company might enter. A retailer becomes a technology platform. A manufacturer becomes a data company. A media service becomes finance, commerce, and infrastructure. Possibility is not probability. Each expansion requires capability, capital, customer permission, and management attention. The investor should identify the specific asset that creates the option and the evidence that management can exercise it. Paying twice a common mistake is paying a premium for the existing business and another premium for uncertain future opportunities. The valuation assumes the core remains excellent and several options succeed. A better structure is to pay a fair or discounted price for the core and treat optionality as upside. This creates asymmetry. The investor is protected by present cash flow while retaining exposure to future success. Management discipline options have value only if management can decline them. A company that pursues every adjacent market converts optionality into distraction. Capital allocation requires sequencing. Test small, define milestones, increase investment when evidence improves, and stop when economics fail. Amazon's history is often discussed as a series of expansions, but the transferable lesson is not to enter every market. It is to build capabilities that make certain adjacencies more logical and to tolerate experimentation within a broader economic system. Private market optionality. A regional business may possess unused licenses, strong local relationships, or a service capability that can support add-on acquisitions. A real estate parcel may have zoning potential. A manufacturer may own specialized certifications that shorten entry into adjacent markets. Underwrite the current cash flow separately. Then assign probability-weighted value to the option, net of required capital and time. The optionality checklist. What specific asset creates the option? Is the option exclusive or easily copied? How much capital is required to test it? What milestones reduce uncertainty? Does exercising it endanger the core? Has management succeeded in adjacent markets before? How much of the current price depends on success? Final principle. The future deserves value but not blind payment. Seek assets where present economics protect the downside and future choices remain open. Optionality becomes powerful when it is owned cheaply, exercised selectively, and supported by real capability. Law 25. Survive first. The first objective of compounding is continuity. A portfolio can recover from a 20% decline. It cannot recover from a 100% loss without new capital. This arithmetic is obvious, yet investing culture often rewards strategies that maximize visible return while hiding the path to ruin. Leverage magnifies gains. Concentration produces dramatic outperformance. Illiquid assets report smooth values. Short volatility strategies collect frequent profits. For a time, fragility can look like skill. Survival means structuring capital so that ordinary mistakes, severe markets, and unexpected events do not end the game. Permanent loss price volatility is uncomfortable. Permanent impairment is different. Permanent loss occurs when the asset's earning power is destroyed. The company is diluted at a distressed price, debt claims absorb the equity, fraud removes the expected value, or the investor is forced to sell before recovery. A temporary decline becomes permanent when financing or behavior removes choice. The survival question is therefore broader than asset quality. It includes position size, leverage, liquidity, and the investor's personal obligations. Ruin mathematics. A 50% loss requires a 100% gain to recover. A 75% loss requires a 300% gain. As drawdowns deepen, the recovery burden rises nonlinearly. Avoiding catastrophic loss is not excessive caution. It is mathematical respect for the compounding base. The investor should distinguish between losses the portfolio can absorb and losses that alter life, business, or future opportunity. Single points of failure ruin often enters through concentration in one unrecognized dependency. A portfolio holds several companies, but all rely on cheap credit. A business serves many customers, but one supplier controls the critical component. A family owns different properties in the same local economy. A founder's net worth, income, and reputation all depend on one company. Count economic dependencies, not merely positions. The survival reserve liquidity reserves protect against forced decisions. The appropriate level depends on income stability, obligations, asset liquidity, and opportunity set. An entrepreneur with volatile income and private investments needs more liquidity than a salaried investor holding marketable securities. A fund with redemption obligations must match the liquidity of assets and liabilities. The reserve may appear inefficient during calm periods. Its value becomes visible when markets are closed, lenders retreat, or personal circumstances change. Counterparty survival. An investment can fail even when the thesis is correct if a broker, lender, custodian, insurer, tenant, or supplier fails. Understand where assets are held, what collateral can be rehypothecated, which guarantees exist, and how claims rank in insolvency. Operational risk is part of investment risk. Jim Simon's organization became known not only for models but for infrastructure, execution, and risk controls. A signal without reliable systems cannot produce durable returns. The Ruin Audit asks, which single event could cause irreversible loss? What amount of leverage is embedded directly or indirectly? Which obligations can force sale? How much capital is exposed to one counterparty or factor? What happens if markets close for 6 months? Which assets can be sold without severe discount? What personal liabilities interact with the portfolio? Which protective rule have I ignored during recent success? Final principle. The desire for maximum return often tempts investors to treat survival as a secondary concern. It is not secondary. Every future opportunity depends on remaining solvent, liquid enough, and psychologically functional. Do not optimize a portfolio for the best year. Build it to remain alive through the worst plausible one. Law 26. Size the position by the downside. A good idea can become a dangerous investment when sized irresponsibly. An analyst may be correct about a company's value and still lose the portfolio. The business is strong. The price is attractive. The thesis is carefully researched. The investor commits 40% of capital. Then a low probability event arrives: fraud, litigation, regulation, a failed drug trial, a cyber attack, or the sudden loss of a key customer. The analysis may have been reasonable. The size was not. Position sizing converts an idea into portfolio risk. Confidence is not enough. Investors often size positions according to conviction. Conviction matters, but it is subjective and vulnerable to overconfidence. Size should reflect at least 5 variables: probability of permanent loss, magnitude of loss, liquidity, correlation with other holdings, and quality of information. A highly liquid security with diversified customers and a strong balance sheet can support a different allocation from an illiquid private company with one founder and one customer. The Kelly insight, the Kelly criterion in simplified form, links position size to edge and odds. Its central lesson is not that every investor should use a formula. It is that optimal size falls when uncertainty or potential loss rises, even when expected value is positive. Full Kelly sizing can create uncomfortable volatility. Many professional investors use fractions of it to reduce drawdowns and model error. The broader principle is humility in sizing. Estimates of edge are less precise than the spreadsheet suggests. Liquidity and exit capacity, a position that can be sold in 1 minute at a narrow spread, is different from one that requires months, approvals, or a willing private buyer. Size illiquid holdings according to the capital that can remain unavailable through adverse conditions. Do not rely on a theoretical secondary market that disappears during stress. For large public positions, examine average trading volume and the market impact of exit. The quoted price may apply only to the next small trade, not to the entire holding. Correlated positions, 5 positions, can behave like one if they depend on the same factor. A bank, home builder, mortgage insurer, and commercial property fund may all be expressions of credit and real estate risk. Position size should be evaluated at both security and theme levels. A concentrated investor can rationally own a few businesses, but must understand how their downside paths overlap. Position creep, a successful holding, can grow into an unintended concentration. The investor may hesitate to trim because the company remains excellent or taxes are significant. Concentration can be permitted when the balance sheet, knowledge, horizon, and personal circumstances support it. The decision should be explicit, not accidental. Review whether the current weight would be chosen today.
A sizing framework classifies position by
knowledge, deep, moderate, limited. Business durability, high, medium, low. Balance sheet resilience, strong, adequate, fragile. Valuation support, substantial, moderate, thin. Liquidity, daily, periodic, highly restricted. Downside, recoverable, severe, potentially total. Larger size requires strength across several dimensions, not merely enthusiasm about upside. Final principle ideas do not damage portfolios. Allocations do. The sophisticated investor treats size as a separate decision from selection. The question is not only, is this attractive? It is, how much can I own while remaining rational and financially intact if I am wrong? Law 27. Diversify by economic risk, not by ticker count. True diversification requires different sources of return and different causes of failure. A portfolio owns 20 securities. On paper, it appears diversified. 10 companies rely on consumer credit. 5 depend on a strong commodity price. 3 are financed through the same short-term market. 2 provide services to the others. When the common factor reverses, the portfolio behaves like one position. Ticker count is not risk diversification. Factor commodity company names to the economic drivers. Interest rates, inflation, credit spreads, commodity prices, housing activity, government spending, consumer confidence, technology cycles, and currency movement can connect apparently different holdings. A software company and a high-growth retailer may both be long-duration assets whose valuations depend on low discount rates. A bank and a real estate fund may both depend on property values and liquidity. Map the factors that create cash flow and valuation. Business model diversification. Diversification can come from different revenue models. Subscription revenue, transaction fees, commodity production, regulated returns, licensing, and essential services respond differently to conditions. Geography can help, but global companies may still share customers and financing. Asset class labels can also mislead. Public equity, private equity, and venture capital may all be exposed to the same growth factor and exit market. The cost of over-diversification. Diversification reduces idiosyncratic risk, but excessive diversification can dilute knowledge and make the portfolio resemble an expensive index. The goal is not to own everything. It is to avoid dependence on one unknowable event while preserving the benefit of strong ideas. Peter Lynch managed a large number of holdings because his process and organization supported broad coverage. An individual investor should not copy the count without the research capacity. Diversification across time, staggering maturities, investment dates, and capital commitments can reduce timing risk. A private market portfolio concentrated in one vintage may face the same entry valuation and exit environment. A bond portfolio with one maturity date creates reinvestment risk. A real estate investor who refinances all properties in 1 year depends on a single credit window. Time is another dimension of diversification. Personal capital. Employment, business ownership, pension, and real estate belong in the risk map. An executive whose salary and stock compensation depend on one company should consider that exposure before buying more shares. A contractor whose income depends on construction may not be diversified by owning home builders. The portfolio does not exist separately from the investor's life. The risk map. Create a table with holdings on one axis and risk factors on the other. Mark sensitivity to growth slowdown, rising rates, inflation, credit stress, commodity changes, regulatory action, currency movement, technology disruption, liquidity withdrawal, one major customer or supplier. Clusters reveal hidden concentration. Final principle. Diversification is not a collection exercise. It is the design of independent ways to survive and prosper. Count the forces that drive the assets, not the symbols displayed on the account statement. Law 28. Correlations rise when protection is needed most. Calm market relationships can fail during panic. A portfolio is built using historical data. The assets appear only modestly correlated. The optimizer produces an efficient balance of return and volatility. Then a crisis arrives. Investors need cash. Funds face redemptions. Dealers reduce balance sheets. Assets that were economically different are sold together because they share owners, financing, or collateral. Not because the assets became identical, but because the sellers did. In stress, market participants sell what they can, not only what they want. A liquid, high-quality asset may decline because it is the easiest source of cash. This creates short-term opportunities for investors with liquidity, but it also reveals a portfolio weakness. Assets can become correlated through funding pressure. Leverage intensifies the effect. Falling prices produce margin calls, which produce selling, which produces further declines. Crowded trades, a position can be fundamentally attractive and still dangerous when many investors own it with similar risk limits. If volatility rises, models may trigger simultaneous reduction. Crowding is difficult to observe directly, but signs include popular narratives, rapid inflows, compressed spreads, low volatility, and similar portfolio construction across funds. The problem is not popularity alone, it is synchronized exit. Private markets smoothing private assets often report less volatility because they are valued periodically rather than traded continuously. The economic exposure may still correlate with public markets through revenue, financing, and exit multiples. A portfolio of private funds can appear stable, while underlying companies face the same recession and credit tightening as public peers. Reported smoothness is not diversification. Stress testing historical correlation is a starting point. Add scenario analysis. What happens if credit spreads widen, equity markets fall, rates rise, and liquidity declines at the same time? Which assets require capital calls? Which lenders can demand collateral? Which positions can be sold? A portfolio should be tested against joint events, not only isolated shocks. Risk parity and its lesson rate Dalio's risk parity framework sought to balance contributions to risk rather than allocate equal dollars. The broader insight is that a portfolio dominated by one source of volatility may be less diversified than its asset weights suggest. No framework is invulnerable. Correlations and volatilities change. The useful discipline is to ask what truly drives risk and how assumptions behave outside the historical sample. Crisis liquidity plan before stress. Decide. Which assets are core and should not be sold for ordinary volatility? Which assets can be liquidated first? What collateral or margin could be required? Which commitments arrive during a downturn? How much cash is available without borrowing? What conditions would trigger rebalancing? Planning in advance reduces the chance that panic becomes the portfolio manager. Final principle diversification that exists only in calm conditions is not sufficient protection. The sophisticated investor studies how assets are financed, who owns them, and what happens when everyone wants liquidity at once. Correlation is not merely a statistical relationship. In crisis, it becomes a behavior. Law 29. Liquidity is more valuable than it appears. Liquidity is an option on survival, negotiation, and future opportunity. During a strong market, cash looks lazy. It earns less than rising assets and creates visible opportunity cost. Investors feel pressure to deploy it. During distress, cash changes character. It becomes protection from forced selling, bargaining power with counterparties, and the ability to buy from people who must act. Liquidity is valuable precisely because its greatest benefits appear when other assets are least available.
Asset liquidity and funding liquidity. Asset liquidity describes the ability to sell without a severe discount.
Funding liquidity describes access to cash or credit. An investor may own marketable assets but face funding stress if those assets become volatile and lenders demand collateral. A company may own valuable property but lack cash for payroll. Do not confuse wealth with liquidity. The liquidity mismatch. Many failures arise from financing long-term or illiquid assets with short-term obligations. Banks, funds, businesses, and individuals can all make this mistake. The asset may be sound over 10 years, but the liability demands cash next month. Match the duration of capital with the duration of the investment. Permanent or long-dated capital can tolerate temporary market closure. Short-term borrowing cannot. Cash as strategic capacity, a company with excess liquidity, can purchase competitors, support customers, invest through a recession, and avoid dilutive financing. It may gain market share while weaker rivals retreat. For the individual investor, cash allows rebalancing into fear. The return on cash should therefore include the value of future options, not only the current yield. Too much liquidity has a cost. Holding excessive cash for years can reduce real returns and become a substitute for making difficult decisions. The appropriate reserve depends on the opportunity set and obligations. A permanently cautious investor can avoid losses and also avoid compounding. The objective is sufficient liquidity, not maximum liquidity. The David Tepper mindset distressed investors often prepare during calm periods. They study capital structures, maintain relationships, and preserve capital. When prices collapse, they can act quickly because analysis and liquidity were assembled in advance. The opportunity may last only days. Preparation converts cash from inactivity into speed. Liquidity tiers organize liquidity into tiers: immediate operating and personal needs, emergency reserve, portfolio rebalancing reserve, opportunistic capital, long-duration illiquid commitments. Each tier has a different purpose. Do not commit the first two tiers to satisfy the return ambitions of the last three. Final principle liquidity is rarely admired at the top of a cycle. It becomes priceless when the cycle turns. Treat cash and marketability as strategic resources. They protect time, preserve choice, and allow the investor to become a buyer when urgency turns others into sellers. Law 30. Use leverage only when survival does not depend on forecasting. Debt turns time into an obligation. An unleveraged investor can be early and remain alive. A leveraged investor can be correct about value and still fail because the lender controls the calendar. Leverage is attractive because it increases ownership with less equity. If the asset return exceeds the borrowing cost, equity returns rise. The arithmetic is simple. The danger lies in the path. Interest must be paid regardless of market opinion. Covenants may tighten. Collateral values may fall. Maturities arrive. Debt converts uncertainty into deadlines. Productive leverage is most defensible when cash flows are predictable, asset values are durable, financing is long-dated, rates are fixed, covenants are manageable, and the borrower maintains liquidity. A regulated utility, stabilized property, or mature contracted business may support more debt than a cyclical manufacturer or early-stage company. The same leverage ratio can carry very different risk depending on the asset. Reflexive leverage. Some leverage depends on rising prices. Borrowers refinance because collateral appreciates. Rising values support more borrowing, which supports more demand, which raises values further. George Soros's reflexivity concept helps explain why such cycles can persist and then reverse violently. When prices fall, collateral weakens, credit contracts, and forced sales accelerate the decline. The investor should identify whether repayment comes from cash flow or from the expectation of a future buyer and lender. Personal leverage margin loans, home equity borrowing, and concentrated business debt can interact. A person may believe each obligation is manageable separately, while the same recession affects income, asset values, and credit access. Stress the household as one balance sheet. Borrowing against volatile securities deserves particular caution. A decline can force sale at the moment expected return is highest. Covenants and controlled debt agreements contain more than an interest rate. They include reporting requirements, financial ratios, collateral provisions, restrictions on distributions, and events of default. A borrower may remain economically solvent while losing control because a covenant is breached. Read the documents or employ someone qualified to do so. Leverage tests before borrowing. Ask, can interest be paid under a severe revenue decline? Can principal be repaid without refinancing? What collateral can be seized? Which covenants can be breached first? Is the rate fixed or floating? What happens if the asset cannot be sold for 2 years? Does the borrower retain liquidity after closing? Would the investment still be attractive with less debt? If the return requires maximum leverage, the underlying economics may be weak. Final principle leverage is not evil. It is an amplifier with a clock attached. Use it when cash flow, structure, and liquidity provide room for error. Avoid it when success depends on accurate forecasts, cooperative markets, and perfect timing. Law 31. Know the difference best between volatility and impairment. Price movement and economic deterioration are different events. A stock falls 30% after a disappointing quarter. One investor panics because the decline feels like proof of danger. Another buys automatically because the shares are cheaper. Both may be wrong. The essential question is whether the decline reflects a temporary change in market price or a permanent reduction in the asset's earning power. Volatility describes movement. It does not explain cause. Prices can move because of sentiment, liquidity, index changes, fund redemptions, interest rates, or short-term results. None automatically changes long-term value. For a well-financed business with durable demand, volatility can create opportunity. Impairment occurs when expected cash flows decline permanently, or the path to realizing them becomes materially riskier. Examples include loss of a structural competitive advantage, permanent customer departure, technological obsolescence, fraud, excessive dilution, environmental liability, or a balance sheet that cannot survive. The word permanent does not require the company to disappear. A lower sustainable margin or shorter growth runway can impair value, even if the business remains profitable. The diagnostic sequence. When price falls, investigate in order. First, identify the new information. Second, determine whether it affects revenue, margin, capital needs, duration, or financing. Third, update the value range. Fourth, compare the new value with the new price. Fifth, review position size and liquidity. This sequence prevents the price chart from becoming the analysis. Stable prices can hide risk. Private investments, bonds held at cost, and thinly traded assets may show little volatility while economic value deteriorates. The absence of a quote does not remove risk. A loan can appear stable until default. A property can carry the same appraisal while tenants weaken. A private company can report unchanged value while losing market share. Stability in reporting is not stability in economics, the long-term investor's excuse. Some investors use long-term language to avoid recognizing impairment. Every decline is temporary. Every warning is noise. Patience becomes denial. Long-term ownership requires more monitoring, not less, because small changes in duration can have large effects on value. Final principle, do not sell merely because price falls, and do not buy merely because it has fallen. Separate the market's movement from the asset's condition. Volatility may be the cost of opportunity. Impairment is the destruction of the opportunity itself. Law 32. Build the exit before you need it. The time to define an exit is before emotion makes it urgent. Buying receives most of the attention in investing. Selling determines whether analysis becomes realized wealth. Without an exit framework, investors tend to sell for emotional reasons: fear after decline, excitement after a quick gain, boredom during an activity, or the desire to make another purchase. A disciplined exit begins at entry. Reasons to sell: the strongest reason is a broken thesis. The business, management, balance sheet, or industry has changed in a way that reduces value materially. A second reason is valuation. The asset may remain excellent while the price assumes returns that are no longer attractive. A third is opportunity cost. Another investment may offer a substantially better risk-adjusted return. A fourth is portfolio risk. A successful position may become too large relative to the investor's financial life. A fifth is the completion of a defined event, such as a merger, restructuring, or development project. Tax, liquidity, and transaction costs belong in the decision, but should not excuse continued ownership of a deteriorating asset. Price targets. A fixed price target can be useful, but value changes with new information and time. If a business compounds successfully, the estimate should rise. Selling automatically at the original target may interrupt a long-duration winner. Use a value range and expected return threshold rather than one permanent number. Staged exits, partial sales can reduce risk while preserving exposure. They are useful when valuation is high, but uncertainty remains, or when concentration has grown beyond comfort. Staging is not a substitute for decision. If the thesis is broken, gradualism may increase loss. Private market exits, private assets require earlier planning. Potential buyers, management succession, financial reporting, legal structure, customer concentration, and data quality influence exit value years before a sale. A business built to operate without the founder receives more interest and better terms. Exit readiness is therefore a form of value creation, not merely transaction preparation. The exit memo before selling: right. What changed since purchase? What is the current value range? What return is expected from today's price? What tax and transaction costs apply? What alternative use exists for the capital? Is the decision driven by evidence or recent price movement? Would I buy the asset today? After sale, avoid evaluating the decision solely by what the price does next. A sound sale may be followed by further gains. Final principle: ownership should not continue by default. It should continue because the expected return remains attractive relative to risk and alternatives. Build the exit while the mind is calm. When evidence changes, the path will already exist. Law 33. The crowd is often right about direction and wrong about price. A correct story can still produce a terrible investment. A technology changes an industry. Demand is real. Adoption accelerates. The companies building the new infrastructure report extraordinary growth. The crowd is not imagining the transformation. It is seeing something important. The error appears when investors treat a real trend as proof that any price is reasonable. They assume the leading company will retain its position, margins will remain elevated, competitors will fail, capital will stay cheap, and the market will continue assigning a premium multiple. The direction can be right while the investment is wrong. Truth and expectations market prices do not respond only to reality. They respond to the difference between reality and expectations. A company can grow 40% and decline if investors expected 60. Another can shrink and rise because the contraction was less severe than feared. The sophisticated investor asks what the price already assumes. A great business can disappoint when expectations are perfect. A troubled business can rally when expectations are catastrophic. Theme investing themes simplify complex change into an investable narrative. Artificial intelligence, electrification, aging populations, cybersecurity, renewable energy, reshoring. Themes can guide research, but they do not identify the winner. Value may accrue to suppliers rather than headline brands, to customers rather than producers, or to a later entrant with a better model. Study the economics across the value chain. Who has pricing power? Who must invest heavily? Where are bottlenecks? Which advantage is durable after capital floods the sector? The adoption curve early growth rates can be spectacular because the base is small. As adoption rises, growth naturally slows. Investors who extrapolate the early rate may pay for a future that arithmetic cannot support. Estimate market saturation, replacement cycles, and the revenue required to justify the valuation. Translate the price into operational assumptions. If the company must serve more customers than the market contains, the story has outrun reality. Historical pattern railways, automobiles, radio, personal computers, the internet, and mobile technology transformed society. Investors did not profit equally from every company involved. Many businesses failed despite the importance of the innovation. A transformative industry can destroy capital through overbuilding, competition, and excessive valuation. A price-implied forecast work backward from the current enterprise value. Estimate the revenue, margin, reinvestment, and duration required to produce an acceptable return. This reverse valuation turns enthusiasm into a test. The question becomes not whether the company is exciting, but whether the future required by the price is. Final principle. Do not oppose the crowd merely to appear independent. The crowd may recognize a genuine change before you do. But distinguish recognition from valuation. A true trend does not grant immunity from price, competition, or capital intensity. The story can be right. Your return can still be wrong. Law 34. Every narrative has an expiration date. Stories organize information, but they become dangerous when they replace evidence. Markets require narratives because the future is complicated. Investors need a framework to explain why earnings will grow, why an industry will recover, or why an asset deserves a premium. A useful narrative connects facts. A dangerous narrative protects itself from facts. When every disappointment is reinterpreted as temporary, every competitor as validation, and every decline as manipulation, the story has become unfalsifiable. How narratives form a narrative usually begins with an observable truth. A new product is gaining users. Rates are falling. Housing is scarce. A country is reforming. A company has a visionary founder. The truth attracts capital. Rising prices attract attention. Media coverage attracts more capital. The narrative broadens until it explains not only current performance but an idealized future. At the peak, ownership becomes a social identity. Narrative drift watch for changes in language. A company originally valued on current cash flow begins to be valued on adjusted earnings, then on revenue, then on users, then on a hypothetical market it has not entered. The metric changes because the earlier metric no longer supports the price. Narrative drift is not proof of fraud or failure. It is a warning that valuation discipline is weakening. Expiration triggers narratives expire when evidence breaks the causal chain. Customer acquisition becomes more expensive, a regulation changes, financing costs rise, a competitor closes the feature gap. Growth slows before profitability arrives. Management credibility weakens. The market may ignore these facts for a time because narratives possess momentum. That delay does not make the facts irrelevant. Soros and Reflexive Stories, George Soros's concept of reflexivity, explains how beliefs can influence fundamentals. A rising stock price can lower the cost of capital, support acquisitions, attract employees, and strengthen the company. The narrative partially creates the reality. The loop can also reverse. Falling prices restrict financing, weaken confidence, and damage operations. The investor must understand both the story and the mechanism that allows the story to affect the asset. Narrative hygiene. Write the thesis without promotional adjectives. Replace category leader with market share. Replace massive opportunity with an addressable market and required penetration. Replace best-in-class management with capital allocation history and forecast accuracy. Then identify the date or event that should produce evidence. A narrative without milestones can survive indefinitely because it is never tested. Final principle stories are necessary. They help the mind connect cause and effect. But a story earns the right to continue only when reality keeps paying its rent. Preserve the narrative as a hypothesis, not a belief system. Every investment story should contain the conditions of its own expiration. Law 35. Fear changes the price before it changes the asset. Panic can create a gap between the need to sell and the value of what is sold. During a market shock, screens turn red before management teams can hold conference calls. Funds face redemptions. Leveraged investors receive margin notices. Risk committees reduce exposure. Exchange-traded products rebalance. The price changes immediately. The asset may take months to show whether its long-term economics changed. This timing gap creates opportunity for prepared capital. The most attractive price often comes from a seller who is not making a valuation decision. He is meeting a redemption, covenant, mandate, tax obligation, or liquidity need. A forced seller asks, "What can I sell now?" The buyer can ask, "What is this worth over time?" The difference in questions creates the transaction. Fear is not always wrong. Contrarianism without analysis is another form of crowd following. Sometimes the price collapses because the asset is impaired. Banks fail, business models break, and recoveries disappoint. The investor must separate indiscriminate selling from accurate repricing. Study liquidity, debt maturity, customer behavior, government response, and the probability of permanent damage. A strong company at a lower price can be attractive. A fragile company may become cheaper because the equity is approaching zero. Preparation before panic. The best crisis purchases are often researched in advance. Build watch lists, understand capital structures, and identify companies able to survive stress. When fear arrives, attention becomes scarce. New research performed under emotional pressure is vulnerable to shortcuts. Prepared investors can update existing work instead of beginning from nothing. David Tepper and Distressed David Tepper's reputation in distressed investing reflects a willingness to purchase when consensus is fearful, but the method is not simply bravery. It requires estimating recovery, policy, liquidity, and survival. Courage without calculation is gambling. Calculation without courage can produce endless observation and no action. The fear checklist during a major decline asks, who is selling and why? Has the asset's cash generation changed? Can the company survive the expected stress period? Which obligations arrive before recovery? Has government or regulatory action changed the payoff? Is the price below conservative value after updated assumptions? How should size reflect uncertainty? Final principle fear moves faster than fundamentals. That speed can create bargains, but only for investors who preserve liquidity, knowledge, and emotional control. Do not buy because others are afraid. Buy when their need to sell creates a price that compensates you for the risk that remains. Law 36. Greed compresses time. The farther the reward lies in the future, the more uncertainty the price should reflect. In speculative markets, distant possibilities are valued as though they already exist. A company plans to enter a market. Investors value it as if entry is certain. Management projects future margins. The market capitalizes those margins today. A technology may take 10 years to mature, but the price reflects full adoption now. Greed compresses time by removing the discount for waiting, execution, competition, and failure. The time value of uncertainty. $1 expected next year is worth more than $1 expected in 10 years because it can be reinvested and because fewer things can go wrong before receipt. Long-duration assets are especially sensitive to discount rates. When rates fall and optimism rises, distant cash flows receive high present values. When rates rise or confidence weakens, valuation can decline dramatically, even if the long-term story remains possible. The investor should understand whether the price depends on cash flows far beyond the forecast horizon. Milestone valuation break the distant future into milestones. Product completion, regulatory approval, customer adoption, unit profitability, and financing are separate risks. Assign capital only as evidence improves. A venture investor may invest in rounds. A public market investor can begin with a smaller position and increase after milestones. Paying the full future value before the milestones transfers most of the upside to the seller and leaves the buyer with execution risk. Growth duration high valuations often require not only rapid growth, but a long period of rapid growth. Competitive response and market saturation make duration difficult to sustain. Model what happens when growth slows 2 years earlier than expected. The valuation may be more sensitive to duration than to the peak growth rate. Greed in private deals during competitive lending and acquisition cycles, buyers project quick integration, easy refinancing, and high exit multiples. 3 years of operational work are compressed into a transaction model. Add time to every optimistic assumption. Delay synergies, extend customer conversion, and reduce the exit multiple. If the return disappears, the model was selling speed rather than value. Final principle. The future deserves a discount because it must travel through time before becoming cash. When enthusiasm brings distant rewards into today's price, restore the years, uncertainty, capital, and competition that the narrative removed. Law 37. Macro conditions matter, but they are not the entire investment. The economy shapes the environment. Business economics determine who can survive within it. Interest rates, inflation, currencies, credit, employment, and government policy influence every asset. Investors who ignore macro conditions can misunderstand financing, valuation, and demand. Investors who focus only on macro forecasts can remain perpetually active and frequently wrong. The challenge is integration. Top-down and bottom-up top-down analysis begins with the economy and selects assets expected to benefit. Bottom-up analysis begins with the company and studies its economics. Neither is complete alone. A strong company can struggle when rates rise if it depends on refinancing. A weak company can perform temporarily in a powerful cycle. The investor should understand both the tide and the vessel. Interest rates affect discount values, borrowing cost, consumer demand, currency flows, and asset allocation. Long-duration growth companies and leveraged properties may be particularly sensitive, but sensitivity varies. A company with net cash may benefit from higher yields. An insurer may earn more on reserves. A bank can gain or lose depending on funding and credit quality. The label rate-sensitive is too broad. Trace the mechanism. Inflation rewards companies with pricing power and low incremental capital needs. It punishes fixed-price contracts, long receivable cycles, and businesses requiring expensive replacement assets. Nominal revenue growth can conceal falling real economics. Evaluate whether margins and returns keep pace with the changing cost base. Credit cycles, equity values, and consumer spending. It can also lower underwriting standards. When credit contracts, assets dependent on refinancing face pressure before operating performance fully deteriorates. The balance sheet becomes the link between macro conditions and security value. Ray Dalio's machine, Ray Dalio, has described the economy through transactions, credit, productivity, and cycles. The practical lesson is to study relationships rather than headlines. One person's spending is another person's income. Debt increases current spending and future obligations. The investor does not need perfect forecasts. He needs to know which variables can materially alter the thesis and to avoid structures that require one precise macro path. Macro-humility economic forecasts are difficult because systems adapt. Central banks respond, governments intervene, consumers change behavior, and markets anticipate events. Use macro analysis to stress assumptions and identify exposure, not to create false certainty. Final principle: do not ignore the weather, and do not confuse weather with the quality of the house. A robust investment should make sense across several plausible economic environments, or provide enough price protection to compensate for dependence on one. Law 38. Reflexivity can move prices away from fundamentals. Perception can influence reality until economic limits break the loop. Traditional analysis often treats fundamentals as causes and prices as effects. Reflexivity adds another direction. Prices can alter fundamentals. A rising share price allows a company to issue equity cheaply, acquire competitors, compensate employees, and strengthen customer confidence. These improvements can justify part of the higher price. The loop feeds itself. A falling price can reverse the process. Financing becomes expensive, employees leave, customers worry, and lenders tighten. Perception damages reality. Positive feedback. Reflexive cycles are common in finance because collateral, confidence, and capital access depend on market values. Property prices rise. Banks lend more against the property. Additional credit supports more purchases. Construction expands. The cycle appears healthy until supply, rates, or credit quality change. The process can persist longer than a static valuation model expects because the price is helping create the reported fundamentals. Breaking points. A reflexive boom ends when the feedback no longer produces sufficient economic improvement. Capital raises dilute faster than value is created. New supply reduces rents. Customers resist prices. Borrowers cannot service debt. The investor should identify the variable that cannot expand indefinitely: short selling and reflexivity. A short seller may be fundamentally correct but face a company that uses its high stock price to improve the business. The position must survive the feedback loop. Conversely, a falling stock can make refinancing difficult and accelerate weakness. Timing becomes part of the thesis. Soros's contribution. George Soros emphasized fallibility and feedback. Market participants act on imperfect perceptions, and their actions alter the situation they are trying to understand. This does not imply fundamentals are irrelevant. It means fundamentals and perceptions can interact dynamically. A reflexivity map for a market-sensitive asset. Diagram. How price affects financing. How financing affects operations. How operations affect reported results. How reported results influence perception. Which constraint can stop the loop? How reinforcing trend from an economic endpoint. Final principle. Price can be more than a score. It can become an input. The sophisticated investor studies feedback without assuming it lasts forever. Reflexive cycles are powerful precisely because they look self-validating before they break. Law 39. Being early is indistinguishable from being wrong without staying power. A thesis about direction is incomplete without a thesis about timing, financing, and endurance. An investor identifies a bubble. Valuations are extreme. Business models are weak. The conclusion is eventually proven correct. The position still loses money because prices rise another 200% before falling. Correctness about the destination does not guarantee survival on the route. Timing risk. Some strategies depend less on whether an event occurs than on when it occurs. Options expire. Short positions require borrow. Leveraged trades face margin. Private funds have investment periods. Businesses face debt maturities. The more timing matters, the less sufficient a general thesis becomes. Carry cost a position can be expensive to maintain. Short sellers pay borrow and may face recalls. Option buyers lose time value. Macro trades can incur negative carry. Distressed investors may fund ongoing losses. Estimate how long the thesis can take and whether the capital can remain committed. Catalyst a carry that can close the gap between price and value. A sale, restructuring, earnings change, regulatory decision, maturity, or change in control. Not every investment needs a catalyst. A compounding business creates value through operations. A deeply undervalued asset with no cash distribution, no control, and no path to recognition may remain cheap indefinitely. The importance of timing depends on how the return is realized. Shorting and asymmetry short positions contain difficult asymmetry. Maximum gain is limited to 100%, while loss can exceed the initial capital. Rising prices can force reduction before the thesis works. A correct short thesis, therefore, requires careful size, borrow stability, and an understanding of reflexive upside. Patience requires financing. Long-term investors often praise patience as temperament. It is also a balance sheet capability. A person with near-term obligations cannot wait through a long recovery. A fund with redemptions may sell at the worst time. Time horizon must be financed. Final principle: do not confuse eventual truth with investable timing. A complete thesis explains what may happen, why it may happen, what can trigger it, how long it may take, and how the position survives until then. Law 40. Never predict without preparing for the opposite. Sophistication is not confidence in one outcome. It is resilience across several outcomes. Investors are rewarded socially for predictions. A precise forecast sounds intelligent. A range sounds uncertain. Capital should prefer the range. The future contains policy changes, inventions, wars, weather, elections, management decisions, and human reactions that no model captures fully. A portfolio built around one confident prediction becomes fragile even when the prediction is reasonable. The opposite case for every major position: construct the case in which the central forecast fails. If rates are expected to fall, examine rising rates. If inflation is expected to decline, test persistence. If a company is expected to gain share, model loss. If a recession is expected, consider continued expansion. The exercise is not to become indecisive. It is to identify which assumptions create unacceptable loss. Barbell thinking. A barbell can combine high safety with limited exposure to high upside uncertainty. The middle may be avoided when it offers mediocre return with hidden risk. This concept can be applied in different ways. The barbell holding eventuation when the assets pressures. The exact structure depends on objectives. The principle is to preserve survival while retaining opportunity. Hedging hedges can reduce specific risk, but they have cost and basis uncertainty. A hedge that performs imperfectly may create false confidence. Define the risk being hedged, the period, the expected cost, and the conditions under which the hedge is removed. Do not purchase complexity merely to feel protected. Operational preparation businesses should also prepare for opposite conditions. A company expecting growth should know how to reduce spending if demand slows. A company expecting stable supply should identify alternatives. A leveraged owner should plan for refinancing failure. Resilience is designed before the shock. The decision tree mapped 3 paths: the central case and intended action, the adverse case and protective action, the favorable surprise and opportunity action. Assign indicators to each path. This creates a plan that can adapt without panic. Final principle predictions are unavoidable. Dependence is optional. Make forecasts, but build structures that can survive their failure. The investor who prepares for the opposite does not weaken conviction. He prevents conviction from becoming fragility. Law 41. Build a circle of competence and defend its borders. Knowing what you do not understand is a financial advantage. A circle of competence is not a list of industries you have heard of. It is the territory in which you can identify the important variables, recognize misleading information, estimate normal economics, and detect when the rules are changing. The circle may be narrow. That is not a weakness. A specialist in regional banks, industrial distribution, commercial roofing, insurance, or software pricing may possess an advantage that a generalist cannot reproduce quickly. The specialist understands which numbers matter, which customer behavior is normal, and which management claim deserves skepticism. The danger begins when success inside the circle creates confidence outside it. Depth before breadth investors often expand their universe because familiar opportunities appear expensive. Instead of waiting, they move into industries with different accounting, regulation, technology, and competitive dynamics. A low valuation can make unfamiliarity feel less important. It should make investigation more important. Cheapness is often the market's warning that the obvious numbers are incomplete. Depth allows an investor to act decisively when price and knowledge align. Breadth is useful only when it does not dilute understanding. The border is not fixed. A circle of competence can expand through deliberate study. Read industry histories, filings, technical material, customer interviews, and failed cases. Build models. Follow the sector through a full cycle. Start with small positions while learning. Expansion should be earned through evidence, not declared because a new opportunity is exciting. The circle can also contract. Technology, regulation, or management change may make old knowledge less useful. Experience becomes dangerous when it creates certainty about a world that no longer exists. Buffett and the discipline of passing Warren Buffett's idea of remaining within a circle of competence is powerful because it treats passing as a valid decision. The investor does not need an opinion about every security. This is difficult in professional settings. Analysts are expected to answer. Managers are expected to deploy capital. Individuals feel pressure when others profit from unfamiliar assets. The right to say, "I do not know," is underused and economically valuable. A competence test before investing. Ask whether you can explain the customer's reason for buying, the industry's profit pool, the cost structure, the key accounting judgments, the balance sheet risks, the competitive response to high returns, the important regulatory constraints, the normal range of margins and valuation, the conditions that would make historical comparisons invalid. If several answers depend entirely on management or an outside expert, the position may belong outside your circle. Borrowed expertise specialists can extend analysis, but the investor must understand enough to evaluate the specialist. A technical consultant may assess a product. A lawyer may interpret regulation. An engineer may evaluate reserves. Expert input is most valuable when the investor knows which question to ask and how the answer affects value. Final principle. The market does not pay extra for the number of assets you can discuss. It rewards accurate decisions where knowledge, price, and patience meet. Expand your circle slowly. Defend its borders aggressively. Opportunity is abundant. Capital is not required to pursue all of it. Law 42. Turn mistakes into intellectual property. An unexamined loss is tuition paid without education received. Every investor will make mistakes. The distinction is whether the mistake becomes a recurring expense or a permanent improvement in process. Loss alone does not create wisdom. Pain can produce denial, blame, and avoidance. Learning requires a structured examination of what happened and what must change. A mistake transformed into a principle becomes intellectual property, knowledge earned through experience and retained for future decisions. Categories of analytical errors arise from incorrect assumptions, weak data, misunderstood economics, or valuation mistakes. Behavioral errors arise from fear, greed, envy, pride, and impatience. Process errors occur when a reasonable method was not followed, diligence was rushed, position limits were ignored, or the thesis was not written. Execution errors arise from trading, financing, legal structure, taxes, or operational implementation. Sometimes the process was sound and the outcome came from a low-probability event. The post-mortem should not invent an error simply because a loss occurred. The no-blame review or review should seek causality, not a villain. Blame makes people defensive and encourages concealment. Accountability asks what information existed, who interpreted it, how the decision was made, and which safeguard failed. In a team, begin with the senior decision-maker's errors. This creates permission for honest discussion. Ray Dalio and the Conversion of Pain. Ray Dalio has emphasized using painful outcomes as signals for reflection and process improvement. The transferable idea is to convert an emotional experience into a principle that can guide repeated decisions. The principle must be specific. Be more careful is not useful. Require customer references from both current and former clients before underwriting retention changes behavior. The mistake ledger. Maintain a ledger with these columns: decision and date, original thesis, actual outcome, error category, evidence missed or misread, position size effect, corrective rule, future trigger for review. Review the ledger before similar decisions. Memory becomes stronger when connected to a recurring process. Near misses. Study mistakes that did not produce losses. A weak process may be rescued by a rising market. A covenant may not be breached because refinancing arrived. A concentrated position may recover. Near misses are valuable because they reveal fragility before the full cost appears. Organizations that learn only from realized disasters learn too slowly. Final principle. The most expensive mistake is not the largest loss. It is the error repeated because the investor protected ego instead of improving the system. Convert every meaningful surprise into a better question, a stronger rule, or a clearer limit. Capital lost once can purchase knowledge. Capital lost repeatedly purchases nothing. Law 43. Build systems for decisions that repeat. A process should become more reliable each time it is used. Investors often treat every opportunity as unique. The assets differ, but many decisions repeat. Screening, diligence, valuation, position sizing, monitoring, and selling. Repeated decisions deserve systems. A system does not remove judgment. It protects judgment from omission, inconsistency, and emotional pressure. The checklist advantage. A checklist is useful when failure can result from forgetting one ordinary item. Pilots and surgeons use them not because they lack expertise, but because expertise does not eliminate human fallibility. An investment checklist might require balance sheet review, customer concentration, management incentives, cash conversion, valuation range, and exit conditions. The list should evolve. Add items when mistakes reveal a recurring weakness. Remove items that produce no useful information. The research pipeline. A professional process can be divided into gates. The first gate is relevance. Does the opportunity fit the mandate and circle of competence? The second is economic quality. Does the asset possess understandable cash generation and survivable risk? The third is valuation. Does price offer an acceptable expected return? The fourth is portfolio fit. How does the position interact with existing exposures? The fifth is execution. What structure, timing, and size are appropriate? Gates prevent teams from spending weeks on an idea that fails a basic requirement. Jim Simons and repeatability. Jim Simons' quantitative work represents an extreme form of systematization. Hypotheses are tested across data, implemented through rules, and evaluated over many observations. Most investors will not build a mathematical trading organization. They can still adopt the discipline of defining a method, measuring results, and reducing dependence on memory. A system should reveal when it no longer works. Processes that cannot be tested become rituals. Monitoring by exception. Not every holding needs equal attention every day. Build thresholds that trigger review. Covenant headroom, customer loss, margin change, share issuance, management turnover, valuation, or regulatory action. Monitoring by exception directs attention toward changes that matter rather than the constant movement of price. Decision rights in organizations define who can recommend, challenge, approve, and execute. Ambiguity allows social hierarchy to replace analysis. A junior analyst should know how to escalate contrary evidence. A risk officer should possess authority to reduce exposure. An operating partner should know which integration decisions require committee approval. Systems include governance, not merely spreadsheets. The personal operating system. An individual investor can create a weekly rhythm, review portfolio risks and liquidity, read primary sources for major holdings, update one watch list company, record decisions and emotional state, study one historical failure. Reconcile new evidence with written theses. Consistency compounds knowledge even when no trade occurs. Final principle: exceptional decisions are valuable. A repeatable method is more valuable because it can produce exceptional decisions again. Build a system that remembers what you forget, challenges what you assume, and improves after every cycle. Law 44. Combine data with judgment. Data without judgment becomes mechanical. Judgment without data becomes self-deception. A model finds a profitable pattern in historical prices. The backtest is impressive. The strategy is launched. Then the pattern disappears because transaction costs were underestimated. The data included information unavailable at the time, or other traders discovered the same signal. Elsewhere, an experienced investor rejects a model because the market feels different. The intuition is strong, but no evidence supports it. Both approaches are incomplete. What data does? Well, data can reveal frequency, magnitude, correlation, and patterns too subtle for memory. It can test whether a belief has worked across many observations. It can expose the difference between anecdote and base rate. A lender can study defaults by vintage. A retailer can compare stores by cohort. A fund can analyze drawdowns and factor exposure. A business buyer can benchmark margins and working capital. Data gives discipline to judgment. What judgment does? Well, judgment recognizes context. A historical relationship may break because regulation, technology, participant behavior changed. Data may be incomplete, biased, or measured under conditions that no longer exist. Private company records may contain inconsistent accounting. A model can optimize noise. Judgment asks whether the data represents the economic question. Base rates and specific evidence begin with the base rate. How often do turnarounds succeed? How many restaurants reach mature margins? What percentage of mergers achieve projected synergies? What is the normal default rate for this credit class? Then adjust for specific evidence. Management quality, balance sheet, price, and structure may justify a different probability. Ignoring base rates creates optimism. Ignoring specific evidence creates blind averaging. The model risk checklist: is the data available as it would have been historically? Are failed companies included? Are transaction costs realistic? Is the sample large enough? Does the relationship have an economic explanation? What regime change could break it? How sensitive is the result to assumptions? Can the model be monitored after deployment? Human override and override process should exist, but it should be recorded. If judgment rejects the model, explain why and later review the result. Unrecorded overrides allow emotion to masquerade as experience. A documented override can become new evidence. Final principle: data and judgment are not rivals. Data disciplines intuition. Judgment interprets data. The sophisticated investor uses each where it is strongest and refuses to hide behind either one. Law 45. Count every cost. Wealth compounds from net returns, not advertised returns. An investment earns 10% before fees, taxes, interest, spreads, dilution, and time. The investor remembers 10. The bank account receives much less. Small costs become large over long periods because they compound against the investor every year. Costs that appear minor in one transaction can consume a meaningful share of lifetime wealth. Visible costs: management fees, performance fees, commissions, legal expenses, financing costs, and taxes are visible. Compare them with the value provided. A higher fee can be rational for a rare skill or access. The question is whether expected net return justifies the cost and whether the fee structure aligns behavior. Hidden costs, bid-ask spreads, market impact, cash drag, turnover, dilution, and opportunity cost are less visible. A fund may report low management fees while trading frequently. A company may call stock compensation non-cash while transferring ownership. A private deal may contain monitoring fees, transaction fees, and expenses charged to the portfolio company. Follow the entire economic flow. Taxes should not dominate a bad investment decision, but after-tax returns matter. Turnover can convert long-term gains into short-term income. Interest and dividends may receive different treatment. Private structures can create complexity in filing obligations. Tax efficiency is one component of allocation, not a substitute for value. Time and attention complex investments consume managerial and emotional attention. A small position requiring constant monitoring may have a poor return on time. For an entrepreneur, the opportunity cost of attention can exceed the financial cost. Capital placed in an unrelated venture may distract from the core business where the owner has a genuine advantage. Net return worksheet: calculate gross expected return, management and incentive fees, financing cost, transaction cost, expected dilution, tax impact, required additional capital, time to liquidity, opportunity cost relative to alternatives. The result is the return that deserves comparison. Final principle, the market advertises gross opportunity. The investor lives on the net outcome. Count every cost, especially the ones described as small, non-cash, temporary, or already reflected elsewhere. Law 46. Protect reputation as carefully as capital. Trust expands opportunity. Misconduct compounds in the opposite direction. Investment is a network of promises. Borrowers promise repayment. Managers promise stewardship. Partners promise disclosure. Sellers represent facts. Advisors promise loyalty to a mandate. A reputation for honesty, preparation, and fair dealing attracts opportunities that are not offered publicly. It lowers the cost of verification. It brings partners back. A reputation for opportunism may produce a profitable transaction and eliminate a decade of future ones. Reputation as an asset. Reputation affects access to capital, talent, information, customers, and sellers. In private markets, owners often choose a buyer based on certainty, treatment of employees, and credibility, not price alone. A trusted investor may receive the first call during distress because counterparties believe he can close and behave reasonably. This asset does not appear on a personal balance sheet, but it has economic value. The temptation of the one-time gain ethical failures are often justified as exceptions. A disclosure can be delayed, a fee interpreted aggressively, a promise narrowed, a minority investor ignored. The decision may improve one outcome. It also teaches everyone involved how the person behaves when incentives become strong. Trust is built slowly and repriced quickly. Fairness and strength protecting reputation does not require weak negotiation. Sophisticated parties can demand strong terms and enforce contracts while remaining clear and consistent. The damage comes from surprise, concealment, and opportunistic reinterpretation after the other party becomes dependent. Governance boards and investment committees should treat reputation risk as economic risk. Ask how a decision would appear to a long-term partner if every fact became public. This test is not a substitute for law. It identifies choices that may be technically permitted and strategically foolish. Anderson Fox's ownership principle ownership is a form of stewardship. Capital gives influence over employees, customers, communities, and partners. The sophisticated investor recognizes that how value is created affects whether it endures. Extractive behavior can temporarily improve cash flow while weakening the relationships that support the enterprise. Final principle money can be rebuilt through future effort. A damaged reputation can close the channels through which future effort becomes opportunity. Treat trust as a compounding asset. Protect it when doing so is inconvenient, because inconvenience is where reputation receives its real test. Law 47. Know when enough is enough. Wealth should expand freedom, not create a more expensive form of captivity. The investor reaches the financial goal he once believed would bring security. The goal moves. A larger house, larger fund, larger company, and larger comparison group create new standards. The portfolio becomes more concentrated because ordinary returns no longer feel sufficient. Leverage increases. The investor accepts risks that were unnecessary to meet any real obligation. Without a definition of enough, success can increase fragility. The moving reference point human beings adapt quickly. What once felt exceptional becomes normal. Social comparison then establishes a higher target. Markets intensify this process because someone is always earning more in a given period. A diversified investor compares himself with the best-performing concentrated fund. A successful founder compares himself with a public company billionaire. The comparison has no endpoint. Enough is not withdrawal. Defining enough does not require abandoning ambition or productive investment. It creates a floor beneath which essential freedom should not be risked. An investor can separate capital required for family security, long-term commitments, and philanthropy from capital allocated to high-variance opportunity. This distinction permits boldness without endangering the foundation. Risk capacity. After success, paradoxically, wealth can increase both capacity and temptation. A wealthy person can absorb more loss in dollars, but may not need to accept more risk. The rational objective may shift from maximum accumulation toward preservation, income, impact, or generational planning. A strategy should evolve when the purpose of capital changes. The enough statement, right? What annual resources support a meaningful life? Which obligations must remain protected? What amount of capital should never be exposed to ruin? Which ambitions justify additional risk? What would I refuse to do even for a larger fortune? How will capital serve family, employees, community, or future work? Clarity reduces the power of envy. Final principle: the market has no concept of enough. It will always offer another trade, another ranking, and another reason to risk what has already been earned. A sophisticated investor decides what capital is for. Without that answer, wealth can become an endless competition that consumes the freedom it was meant to create. Law 48. Compound judgment, not merely money. The greatest portfolio is the mind that improves throughout a lifetime. Money compounds when returns are reinvested. Judgment compounds when experience is examined, knowledge is connected, relationships deepen, and errors change future behavior. The second form of compounding makes the first more durable. A young investor may possess little capital but a long runway for learning. An older investor may possess substantial capital and decades of pattern recognition. Both can improve if they remain curious and honest. The layers of judgment knowledge is the first layer. Accounting, valuation, industry, law, psychology, and history. Experience is the second, seeing how management behaves, how cycles turn, and how models fail. Reflection is the third, separating luck from skill and converting events into principles. Character is the fourth, patience, courage, humility, and integrity under pressure. Judgment appears when these layers interact in real decisions. Learning across disciplines, investing benefits from studying beyond finance. Psychology explains bias. History reveals recurring behavior. Engineering teaches margins of safety. Biology shows adaptation. Law clarifies rights. Strategy expertise. Operations reveal how value is created before it appears in financial statements. A broad mind can still maintain a narrow investment circle. The disciplines enrich judgment inside the circle. Relationships compound trustworthy partners, managers, customers, advisors, and fellow investors improve opportunity and decision quality. Long relationships reduce information friction and reveal character across cycles. Treat relationships as long-duration assets. Choose them carefully and contribute value before requesting it. The mastery loop. The practice of mastery follows a loop. Study the opportunity, write the thesis, size the risk, execute with discipline, monitor evidence, update without ego, record the outcome, improve the process. The loop never ends. Success can be reviewed as rigorously as failure, the final comparison. A person who earns high returns for several years through leverage and luck may appear superior to a disciplined investor compounding steadily. Time reveals the difference. Sophistication is not demonstrated by one remarkable period. It is demonstrated the ability to preserve capital, adapt, remain trusted, and continue making useful decisions across changing worlds. Final principle capital is temporary stewardship. Judgment is the instrument that determines what the stewardship becomes. Compound knowledge, discipline, relationships, and character. Money is more likely to follow, and less likely to control you when it does. Conclusion: the investor you become. The 48 laws do not produce certainty. They produce a way of approaching uncertainty. Markets will continue to surprise. Strong businesses will disappoint. Weak businesses will rally. Brilliant people will make poor decisions. Ordinary people will discover exceptional opportunities. New technologies will create value and speculation at the same time. Credit will expand, confidence will rise, and forgotten risks will return. The sophisticated investor does not demand a world without surprise. He builds a structure that can learn from surprise. He governs emotion before allocating capital. He defines the game. He turns borrowed ideas into personal understanding. He thinks in probabilities. He distinguishes process from outcome and removes ego from revision. He studies cash, balance sheets, unit economics, pricing power, and reinvestment. He evaluates the people deciding what happens to the next dollar. He respects incentives, per share value, and the difference between growth and productive growth. He survives. He sizes the downside. He diversifies across economic risks. He preserves liquidity and treats leverage as a claim on time. He knows that a falling price can be an opportunity or a warning, and he prepares the exit before urgency arrives. He studies the crowd without automatically joining or opposing it. He knows narratives expire. Fear can create forced sellers. Greed can bring distant dreams into today's price, and macro forecasts are useful only when joined to asset-level economics. He builds a circle of competence, converts mistakes into property, designs repeatable systems, combines data with judgment, counts every cost, protects reputation, defines enough, and compounds the quality of decision itself. No investor will obey every law perfectly. The laws are not a performance of purity. They are a set of instruments for returning to rational ground. When emotion rises, return to the written thesis. When opportunity becomes fashionable, return to price and value. When the model becomes precise, return to uncertainty. When success creates confidence, return to the error ledger. When fear becomes overwhelming, return to liquidity, balance sheet strength, and the reason the asset was purchased. When wealth grows, return to purpose. The deepest change is not a better portfolio. It is a better investor. A better investor sees capital as responsibility rather than entertainment. He understands that every allocation expresses a belief about value, time, people, and risk. He knows that wealth created dishonestly or recklessly is less durable than it appears. He recognizes that patience and action are not opposites. Patient preparation creates decisive action. The market will keep offering chances to forget these lessons. That is why mastery is a practice. Your advantage will not come from remembering all 48 titles. It will come from applying one law at the moment when violating it feels most attractive. That is the moment the law becomes yours. The Sophisticated Investor's Workbook. The purpose of this workbook is to convert principles into operating habits. It can be used for public securities, private companies, real estate, credit, funds, and strategic acquisitions. Not every field applies to every asset. The discipline lies in deciding what matters and documenting the decision before the outcome becomes known. Workbook 1. The Investment Constitution. An investment constitution defines the purpose and boundaries of capital. Complete it before building or materially changing a portfolio. Purpose of capital: write a direct statement explaining what the capital must accomplish. Avoid vague phrases such as make money. Examples of concrete objectives include preserving purchasing power, funding future obligations, producing dependable income, acquiring control of operating businesses, or compounding long-term family wealth. Primary purpose. Secondary purposes. Time horizon: identify the earliest date at which capital may be needed and the longest period it can remain committed. Near-term obligations within 3 years. Capital available for 3 to 10 years. Capital intended for 10 years or longer. Loss capacity: separate emotional tolerance from financial capacity. A decline that would feel uncomfortable but remain financially manageable. A loss that would impair family, business, or contractual obligations. Assets or reserves that must not be exposed to permanent loss. Permitted strategies: list the strategies you understand and are authorized to use. Prohibited behavior examples may include borrowing against volatile securities, investing emergency reserves, purchasing assets outside a defined circle of competence, or committing capital without a written thesis. Review rules. Define how frequently the Constitution will be reviewed and what life events require immediate revision. Workbook 2. The One-Page Investment Memo. A one-page memo is not a substitute for diligence. It is a test of whether the diligence produced clarity. Opportunity: describe the investment in one sentence using economic language. How value is created: explain how cash reaches the owner. Include the role of customers, operations, financing, and reinvestment. Current price and value range: current price or enterprise value, conservative value, central value, exceptional value. 3 decisive assumptions. Principal risks: state the mechanism of loss rather than using broad labels. Source of edge: why might your conclusion differ from the market or other bidders? Position size and structure evidence to monitor kill criteria. What evidence would force reduction or exit? Workbook 3. Business Quality Diagnostic. #Customer Value Score. For evidence, the text presents a structured framework for evaluating business quality across multiple dimensions, which addresses a real analytical need for investors conducting fundamental research. The framework is comprehensive, covering value, revenue, pricing, margins, cash conversion, balance sheet, competitive position, reinvestment, and governance. Failure cost for the user is moderate. An incomplete framework could lead to missed risks in investment analysis. Value is measurable through the scoring system and evidence requirements, though the framework itself is generic rather than tailored to a specific industry or business model. #Revenue Quality Score. 3 evidence. The framework explicitly asks about recurrence, contracts, repeat behavior, retention, cyclicality, and concentration. This demonstrates awareness of revenue quality dimensions. However, the framework is a checklist rather than a methodology. It does not provide guidance on how to weight these factors or what constitutes acceptable versus concerning patterns. The evidence requirement is strong, but the framework lacks benchmarks or thresholds for evaluation. #Pricing Power Score. 3 evidence asks for realized price, churn, discounts, competitive alternatives, and switching cost. This covers the key inputs for assessing pricing power. The weakness is the absence of guidance on how to interpret these signals. For instance, what level of churn indicates weak pricing power, or how switching costs should be weighed against competitive alternatives. The framework identifies the right questions but leaves interpretation entirely to the user. #margin structure score. For evidence, the framework covers gross margin, operating leverage, fixed costs, labor intensity, and input price sensitivity. This is a thorough set of margin drivers. The inclusion of operating leverage and labor intensity shows sophistication beyond basic margin analysis. The framework would benefit from guidance on how these factors interact. For example, how fixed costs amplify operating leverage, or how labor intensity constrains scalability. #cash conversion score. For evidence, distinguishes operating earnings from free cash flow and explicitly accounts for working capital and maintenance investment. This is a rigorous approach that avoids the common trap of equating accounting earnings with cash generation. The comparison between earnings and free cash flow is the right analytical frame. The framework could be strengthened by addressing the time horizon over which conversion should be measured. #balance sheet strength score. For evidence, the framework covers liquidity, maturity schedule, fixed charges, covenants, and contingent liabilities. This is a comprehensive set of balance sheet risk factors. The inclusion of contingent liabilities and covenants shows awareness of off-balance sheet risks that often escape basic analysis. The maturity schedule consideration demonstrates understanding of refinancing risk. This is one of the stronger dimensions of the framework. #competitive durability score. For evidence, the framework asks for the source of advantage, required maintenance, and strongest attack vector. This is an excellent framing. It forces the user to identify not just what the advantage is, but what it costs to sustain and how it could be undermined. The attack vector question is particularly valuable because it shifts analysis from static description to dynamic threat assessment. This is the most analytically sophisticated dimension of the framework. #reinvestment runway score. 3 evidence. The framework asks for the amount and duration of capital that can be deployed at attractive incremental returns. This is the right question, but the framework provides no guidance on how to estimate incremental returns or what constitutes attractive in different contexts. The concept is sound. The operational guidance is thin. The framework would benefit from examples of how to assess reinvestment opportunities across different business models. #management and governance score. For evidence, the framework covers candor, execution, capital allocation, incentives, succession, and treatment of minority owners. This is a comprehension fact. The inclusion of succession planning and minority owner treatment shows awareness of risks that often surface only after problems emerge. The capital allocation question is particularly important and well-placed. This dimension demonstrates strong analytical coverage. #overall judgment score. For evidence, the framework's 2 greatest strengths are its comprehensiveness and its emphasis on evidence over scores. The explicit instruction that a score is less important than the evidence supporting it is a sophisticated analytical principle that prevents the framework from becoming a superficial scoring exercise. The competitive durability dimension, with its focus on attack vectors, is the most distinctive and valuable component. The framework's most significant weakness is the absence of guidance on how to weigh dimensions against each other. A company might score poorly on revenue quality, but exceptionally on competitive durability. The framework does not help the user determine which matters more in a given context. Additionally, the framework lacks any guidance on how to handle conflicting evidence within a single dimension. The thesis-destroying weakness would be an over-reliance on the scores themselves, treating the framework as a mechanical tool rather than an analytical aid. Workbook 4, Earnings Quality and Cash Conversion Review, Reconciliation Record Revenue, Operating Profit, Net Income, Operating Cash Flow, Capital Expenditure, and Free Cash Flow. Use at least 5 years of data where available. Years reviewed. Largest divergence between earnings and cash. Receivables are receivables growing faster than revenue. Have payment terms changed? Is one customer responsible? Inventory is inventory growth explained by demand, supply chain preparation, obsolescence, or weak sales? Payables and customer funding? Is cash conversion supported by delayed supplier payment or customer prepayment? Is the pattern sustainable? Capital expenditures separate maintenance from expansion. Explain the basis for the estimate. Adjustments list every major adjustment to reported earnings. Determine whether it is genuinely unusual. Owner earnings estimate operating cash flow, less maintenance investment, less recurring obligations not captured above, normalized owner earnings. Conclusion: what percentage of reported profit becomes usable cash across a cycle? Workbook 5, Management and Capital Allocation Review. Operating record list management's most important promises from prior years and compare them with actual outcomes. Allocation history for each category, summarize decisions and results. Core reinvestment, acquisitions, debt reduction or borrowing, share issuance or repurchases, dividends or distributions, incentive structure. What measures determine compensation? Which behavior can improve the metric while weakening long-term value? Candor test: does management discuss failed investments, changed assumptions, dilution, and acquisition results? Provide examples. Succession and dependence: which responsibilities depend on one person? What happens if that person leaves? Owner orientation: does communication focus on total size or per share value? Does management purchase meaningful equity with personal capital? Are related party transactions reasonable? Final judgment: would you trust this team with the next dollar? Explain why. Workbook 6, The Acquisition Underwriting Sheet. This worksheet is designed for buyers of private businesses and for investors evaluating acquisitive public companies. Transaction overview: target, industry, purchase price, debt assumed, fees and integration reserve, total invested cost, normalized earnings. Reconcile seller reported earnings with normalized EBITDA, operating profit, and free cash flow. Identify every adjustment. Customer and revenue risk. List the 5 largest customers, contract terms, retention history, and concentration. Owner dependence: which relationships, decisions, sales, licenses, or technical knowledge depend on the current owner. Working capital and maintenance needs integration plan. State what changes in the first 30, 100, and 365 days. Synergy disciplines: separate cost, revenue, financing, and tax synergies. Identify which are controllable and which depend on customer behavior. Debt stress test: model revenue decline, margin compression, delayed collections, and higher rates. Record covenant headroom and liquidity. Walkaway conditions. Workbook 7, Position Sizing Matrix. Position size should reflect downside, knowledge, liquidity, and portfolio interaction. Knowledge: deep. You understand industry structure, accounting, management, and downside paths. Moderate. You understand the main economics but depend on several outside assumptions. Limited. The thesis relies heavily on management, a specialist, or a new market. Circle 1. Deep, moderate, limited. Financial resilience. Circle 1. Strong, adequate, fragile, explain. Valuation support. Circle 1. Substantial, moderate, thin, explain. Liquidity. Circle 1. Daily, periodic. Restricted, highly illiquid. Downside. Circle 1. Recoverable, severe. Potentially total. Correlation. Which existing holdings or personal income sources share the same risk? Maximum position. State the maximum position as a percentage of investable capital and the reason. Reduction triggers. Workbook 8, Portfolio Risk Map. List each major holding and identify its sensitivity to the following factors: growth slowdown rising, interest rates, persistent inflation, credit contraction, commodity price movement, regulatory change, currency movement, technology disruption, liquidity withdrawal, customer or supplier concentration, common dependencies. Which risks appear across several holdings? Portfolio action. What exposure should be reduced, hedged, diversified, or supported with liquidity? Workbook 9, Scenario and Probability Table. Create 4 cases for every material investment. Resilience case. Describe simultaneous disappointments. Include revenue, margin, financing, and valuation. Probability. Estimated result. Can the investor and asset survive? Conservative case. Describe ordinary performance with limited help from markets. Probability. Estimated result. Central case. State the most defensible path. Probability. Estimated result. Exceptional case. Identify upside not required for the investment to work. Probability. Estimated result. Weighted judgment. Which case contributes most of the expected value? Does the opportunity remain attractive without the exceptional case? Evidence that changes probabilities. Workbook 10, The Pre-Mortem and Reverse Pre-Mortem. Pre-mortem, imagine it is 3 years from today and the investment has failed. Write the most plausible explanation in narrative form. What early indicator did you ignore? What action could have reduced the loss? Reverse pre-mortem, imagine the investment became exceptional. What occurred beyond the central case? Which upside required skill and which required luck? What additional capital or operational capability was needed? Decision, does the downside remain survivable? Is the upside being purchased cheaply? Workbook 11, the monitoring dashboard. Monitoring should follow the thesis rather than the convenience of available data. Thesis variable 1, variable, current measure, warning threshold, action if triggered. Thesis variable 2, variable, current measure, warning threshold, action if triggered. Thesis variable 3, variable, current measure, warning threshold, action if triggered. Balance sheet indicators track liquidity, interest coverage, maturity, covenant headroom, and working capital. Management indicators track forecast accuracy, turnover, capital allocation, and communication quality. Valuation indicators update normalized earning power, value range, and expected return. Review frequency define which indicators require monthly, quarterly, or annual review. Workbook 12, the exit memo. Complete this before selling a material position. Original thesis, what change distinguish business evidence from price movement? Current value range, expected return from today's price alternative, use of capital tax and transaction effects, reason for sale circle, the principal reason. Broken thesis, excess valuation, better opportunity, risk control, event completed, liquidity need, other. Explain, would you buy today? Conditions for re-entry. Workbook 13, the investment post-mortem. Complete this after an exit or after a major outcome becomes clear. Original belief. What did you expect and why? Actual outcome return, attribution. Estimate the contribution from operating performance, cash distributions, debt change, share count change, valuation change, currency or macro conditions, luck or one-time events. Error classification circle all that apply. Analytical, behavioral, process, execution, position sizing. No material error. Evidence missed corrective rule. Write a specific change in process. Generalizable lesson. What lesson applies beyond this one investment? Workbook 14, the enough statement. Capital should serve a defined life rather than an endless comparison. Essential freedom. What annual resources support a stable and meaningful life? Protected capital, what amount should not be exposed to permanent impairment? Productive ambition, which goals justify taking additional risk? Non-negotiable boundaries. What would you refuse to do even for a larger financial result? Stewardship. How should capital serve family, partners, employees, community, and future work? Definition of enough. One paragraph that can be reviewed when envy or ambition begins to move the goal. Workbook 15, Annual Investor Review. Complete this review once each year, preferably during a calm period. Portfolio result. What was the net return after fees, taxes, financing, and dilution? Decision quality. Which 3 decisions were strongest, regardless of outcome? Which 3 decisions were weakest? Behavioral review. Which emotion influenced capital most strongly this year? Risk review. What common exposure was underestimated? Learning review. Which industry, discipline, or skill expanded your circle of competence? Relationship review, which partners improved decision quality. Which relationships created risk? Process improvement. Name 3 rules or systems to improve next year. Capital purpose, did the portfolio serve the purpose defined in the investment constitution? Casebook. 11 investment minds, 11 different edges. The following profiles are not endorsements and are not invitations to imitate personalities. They are studies in method. Each investor operated under different conditions, with different capital, teams, objectives, and tolerances for loss. The lesson is to understand the internal logic of the approach and the limits that accompany it. Warren Buffett, The Architecture of Patient Ownership. Warren Buffett is commonly described as a value investor, but the label does not fully capture the evolution of his method. Early in his career, he searched for securities trading below conservative estimates of asset value. These opportunities could be statistically cheap without representing excellent businesses. Over time, influenced by Charlie Munger and experience, the emphasis moved toward businesses capable of earning high returns on capital for long periods. The change is important. A cheap asset can produce a profitable closing of the gap between price and value. A durable compounder can continue increasing value after purchase. The first relies more heavily on the market, eventually recognizing a discrepancy. The second relies on the business itself. Buffett's method also highlights the interaction of temperament and structure. Berkshire Hathaway has often held substantial liquidity and has not been required to invest merely because markets were open. Permanent capital allows patience that many fund structures cannot tolerate. Insurance float, wholly owned businesses, public securities, and reputation expanded the opportunity set. The not to copy a particular holding. It is to think like an owner. Examine the economics of the entire enterprise. Evaluate management's use of cash. Consider whether the business can reinvest without needing constant outside capital. Demand a price that permits a satisfactory return without heroic assumptions. Buffett's public communications also demonstrate the value of clear language. Complex financial events can often be explained in ordinary economic terms. When a thesis requires excessive jargon, the investor may not understand it as well as he believes. The limit of the method is equally instructive. Long-term ownership does not remove valuation risk. Quality can become popular. A wonderful company purchased at a price that discounts decades of perfection can produce disappointing returns. Patience cannot repair an excessive entry price unless future economics exceed already extraordinary expectations. The law connected most closely with Buffett is not simply hold forever. It is to combine business quality, rational allocation, price discipline, and a structure that allows time to work. George Soros. Reflexivity, fallibility, and the courage to reverse. George Soros represents a very different tradition. His work is associated with macroeconomic imbalances, currencies, political change, and reflexivity. Reflexivity begins with the recognition that market participants act on imperfect understanding. Their actions can alter the reality they are trying to predict. A rising market can improve financing and confidence, which improves fundamentals, which supports higher prices. The loop may continue until an economic constraint breaks it. This framework helps explain why markets can move far from a static estimate of value and remain there longer than expected. It also explains why timing matters. A fundamentally correct conclusion may be unprofitable if the feedback loop continues and the position cannot survive. Soros's emphasis on fallibility is equally important. An investor can hold strong conviction while accepting that the thesis may be wrong. The practical expression is willingness to cut or reverse when price behavior and evidence contradict the original view. This is not emotional trading. It is a disciplined refusal to defend identity. A macro investor often works with incomplete information, policy uncertainty, and rapidly changing feedback. The ability to update may be more valuable than the elegance of the initial forecast. The danger in applying the Soros lesson is to treat every price move as information and abandon analysis too quickly. Reflexivity does not mean fundamentals are irrelevant. It means perception and fundamentals interact. The investor must distinguish a temporary market movement from evidence that the underlying loop has changed. Soros's method is difficult to copy because it depends on judgment, positioning, market structure, and risk control. The ordinary investor should not imitate the size or speed of a famous macro trade. The useful lesson is to identify feedback, preserve the right to change, and never allow public conviction to become private captivity. Jim Simons. The discipline of evidence and repeatability. Jim Simons brought a scientific and mathematical culture to investment management. The popular image focuses on equations, computing power, and extraordinary returns. The deeper lesson is organizational. A systematic process begins with hypotheses that can be tested. Data is cleaned. Signals are examined across many observations. Transaction costs, implementation, and decay matter. Individual intuition is not trusted merely because it belongs to a senior person. This approach reduces dependence on storytelling. A compelling explanation is insufficient without evidence that the pattern persists after costs and outside the period used to discover it. Simons' work also demonstrates that an edge can be small and still valuable when repeated frequently, diversified, and executed reliably. The romantic search for one enormous idea can distract investors from modest advantages that compound across thousands of decisions. The organization surrounding the model matters as much as the model. Research technology, data, risk management, and execution must cooperate. A signal discovered in a notebook has no value if the system cannot trade it accurately or if market impact consumes the return. For a non-quantitative investor, the transferable practices are clear. Record decisions. Test beliefs against base rates. Separate anecdotes from patterns. Define recurring processes. Measure whether the method is working. Treat data quality as an investment issue. The limitation is model risk. Historical relationships can disappear. Data can contain bias. Crowding can reduce returns. A strategy optimized to the past may fail in a new regime. Human judgment remains necessary to decide whether the evidence represents a durable economic relationship or an accidental pattern. Simons's greatest lesson is not that machines should replace investors. It is that repeatable decisions deserve a repeatable method, and confidence should be earned through evidence rather than eloquence. Ray Dalio, Cycles, Systems, and Balanced Risk. Ray Dalio's investing philosophy combines macroeconomic observation, principles, organizational process, and portfolio construction. His economic framework views the system through transactions, income, spending, credit, productivity, and policy. Credit allows spending to exceed current income, but it also creates future obligations. Expansion and contraction emerge from the interaction of these forces. The practical value of this framework is not perfect forecasting. It is exposure awareness. An investor should know how holdings respond to growth, inflation, rates, and liquidity. A portfolio that appears diversified by asset class may be dominated by one economic outcome. Risk parity concepts attempt to balance contributions to risk rather than assign equal dollars. A small allocation to a volatile asset can influence a portfolio more than a large allocation to a stable one. The lesson is to examine what drives the volatility and loss, not merely the percentage weight. Dalio's organizational emphasis on principles and reflection also offers a transferable lesson. Decisions improve when assumptions are explicit, disagreements can be examined, and mistakes become changes in process. No system is permanent. Correlations change, volatility rises, and economic regimes can challenge historical relationships. A balanced portfolio still depends on assumptions about how assets behave under stress. The individual investor can use Dalio's ideas by mapping economic exposures, stress testing joint scenarios, and writing rules before a crisis. The objective is not to recreate an institutional strategy. It is to avoid owning several assets that all require the same world. Ken Griffin. Talent, Infrastructure, and Multi-Strategy Control. Ken Griffin's investment career is associated with the development of Citadel into a large multi-strategy organization. The visible result is scale. The underlying study is how talent, information, technology, and risk can be coordinated across many teams. A multi-strategy platform must distinguish local conviction from firm-level exposure. Individual managers may hold positions that appear independent, while the organization accumulates common factor risk. Central risk systems therefore become essential. The method also depends on talent density. Specialized teams can develop deeper knowledge in equities, credit, commodities, macro, and quantitative strategies than a small generalist group. The platform seeks to combine those local edges while controlling aggregate loss. Technology and execution are not support functions. In modern markets, speed, data, financing, and operational reliability influence return. A strong idea poorly executed may produce little value. The transferable lesson for smaller investors is not to mimic a vast platform. It is to recognize that portfolio construction, operations, and research quality are inseparable. A person who owns several strategies should understand how they interact. A family office that invests across funds should evaluate common exposures and liquidity terms at the consolidated level. The limitation of multi-strategy complexity is that systems can become difficult to understand from outside. Leverage, counterparties, and correlated reactions matter. The investor allocating to any complex organization should demand clarity about risk governance, not merely historical performance. Carl Icahn. Control, Governance, and the Value of Influence. Carl Icahn's career illustrates a truth often ignored by passive investors. Value can exist inside a company without a mechanism to reach shareholders. An enterprise may own strong assets while management allocates capital poorly, maintains an inefficient structure, resists strategic alternatives, or protects itself from accountability. An activist investor seeks influence through ownership, board representation, public pressure, or transactions. The strategy changes the question from what is the company worth under current management to what could the assets be worth under a different plan, and can the investor cause the change? Control has economic value. A private equity buyer can replace management, sell divisions, change incentives, and restructure financing. A small public shareholder cannot. The same asset can therefore possess different value to different owners. Activism also introduces conflict, timing, legal cost, and reputational risk. Management may resist. Other shareholders may disagree. The proposed change may be simpler in presentation than in execution. The transferable lesson is to evaluate governance and the path to realization. A cheap company with entrenched management and no catalyst may remain cheap. An asset with an achievable plan and credible influence may offer a different payoff. The warning is to avoid assuming that every cost cut or asset sale creates durable value. Short-term distributions can weaken long-term earning power. Good activism improves the use of assets. Bad activism merely extracts them. Steve Cohen. Information, Adaptation, and Active Risk. Steve Cohen is associated with active equity trading, rapid information processing, and the development of Point 72. His style differs from long-term concentrated ownership. Active investing requires a clear understanding of time horizon. A short-term thesis may depend on earnings revisions, positioning, catalysts, or changes in expectations. It does not rely on a multi-decade estimate of intrinsic value. The strength of such a method lies in adaptation. New evidence can be incorporated quickly, and positions can be resized as probabilities change. The weakness is that constant activity can invite noise, overtrading, and dependence on execution. An organization built around active decisions needs disciplined loss limits, data, specialist knowledge, and review. The investor must distinguish a thesis that is wrong from one that is merely early. They must also recognize that short horizons provide less time for recovery. The lesson for long-term investors is not to trade more frequently. It is to understand the horizon embedded in every idea. A position purchased for an event should not become a permanent holding after the event fails. A long-term ownership thesis should not be abandoned because a short-term estimate changes. Cohen's career also highlights the importance of institutional compliance and governance in sophisticated financial organizations. Talent and performance cannot substitute for a culture that respects legal and ethical boundaries. David Tepper. Distress, Liquidity, and Buying from Urgency. David Tepper became known for investing in distressed debt and equity, especially during periods when fear created severe discounts. Distressed investing is often described as contrarian, but the word is too simple. Buying what others dislike is not automatically intelligent. The work requires understanding the capital structure, recovery value, policy, liquidity, and the time available before cash is exhausted. A distressed security can offer attractive asymmetry when price reflects near total loss, while assets, government action, refinancing, or restructuring support a higher recovery. The buyer is compensated for uncertainty. Liquidity creates the ability to act. During crises, forced sellers may liquidate strong and weak assets together. Investors who prepared during calm periods can purchase at terms unavailable when confidence returns. Tepper's approach also demonstrates the importance of changing the level of the capital structure. Equity may be too risky, while senior debt offers sufficient recovery. Preferred securities may provide a different balance. The sophisticated investor asks which claim offers the best risk-adjusted payoff, not which security is most familiar. The danger is mistaking low price for value. Distressed companies can consume cash rapidly, and legal priority may differ from expectation. Recovery analysis must be conservative. The transferable lesson is to preserve liquidity, understand claim priority, and recognize that fear can create opportunity only when the asset survives. Peter Lynch. Observation, Simplicity, and the Investigative Advantage. Peter Lynch is remembered for encouraging investors to notice businesses and products in ordinary life. The idea is frequently reduced to buy what you know. That simplification can be dangerous. Knowing a product is not the same as understanding the company. A popular store can have poor margins. A wonderful product can belong to a heavily indebted business. A growing brand can already be priced for perfection. The real advantage of observation is earlier curiosity. A customer may notice rising demand, strong service, or a new category before it becomes obvious in financial screens. That observation should lead to research. Lynch's approach also valued understandable stories. The investor should know why earnings may grow, what category the company belongs to, and which facts would invalidate the story. His broad portfolio demonstrates that successful investing can contain many ideas when the research system supports them. It should not be used to justify owning more companies than one can monitor. The transferable lesson is to combine real-world observation with financial discipline. Visit locations, speak with customers, understand products, and then examine valuation, balance sheet, share count, and competitive response. Investing begins in life and ends in economics. Bill Ackman, Concentration, Activism, and Thesis Discipline. Bill Ackman's investing is associated with concentrated positions, extensive public analysis, and activism. Concentration can produce exceptional results when knowledge is deep and the thesis is correct. It also magnifies analytical error, timing risk, and emotional pressure. The investor cannot hide weak thinking inside a large portfolio. Activism seeks to influence management, capital allocation, governance, or strategy. A concentrated activist can devote resources, develop a detailed plan, and engage publicly. This creates a potential edge unavailable to passive holders. Public conviction has a cost. Once a thesis becomes associated with the investor's identity, changing it can become psychologically and reputationally difficult. The discipline is to preserve the right to update despite the public record. Ackman's career contains examples of strong conviction producing large gains and of high-profile theses creating significant losses. The balanced lesson is not to avoid concentration or public analysis. It is to match size with downside, maintain independent review, and distinguish perseverance from attachment. A concentrated position should have stronger evidence, more conservative financing, clearer monitoring, and a more explicit exit plan than an ordinary holding. Anderson Fox, Ownership, Private Equity, and Shareholder Value Creation. Anderson Fox's framework connects the public market investor with the private owner. Public investors often analyze businesses from outside. Private equity investors and operators can influence management, pricing, systems, incentives, acquisitions, financing, and exit. This control creates opportunity and responsibility. The central question is not merely what a business is worth today, it is what the business can become under disciplined ownership, and how much capital, time, and risk are required to produce that outcome. The approach begins with economic truth. Normalize earnings, follow cash, identify owner dependence, customer concentration, working capital, maintenance investment, and balance sheet fragility. A transaction model built on flattering numbers will create a false return before the deal closes. Next comes the value creation map. Pricing, sales effectiveness, procurement, technology, management, and acquisitions should be ranked by expected return and execution difficulty. A company does not need 50 strategic priorities. It needs a few initiatives that change the economics. Capital structure must serve the enterprise. Debt can improve equity return, but excessive leverage transfers control to the calendar and lender. The business should be able to survive ordinary disappointment without sacrificing the long-term plan. Finally, ownership should increase institutional quality. The company should become less dependent on one person, more capable of producing accurate information, and more valuable to customers and future owners. The broader lesson is that sophisticated investing does not end at security selection. It reaches into governance, operations, incentives, and the human systems through which financial value is created. The 48 Laws. Quick reference. 1. Protect the mind before you protect the money. Emotional capture begins before financial loss. Build procedures that keep fear, envy, greed, pride, and boredom from becoming the hidden portfolio manager. 2. Define the game before you enter it. State the objective, time horizon, liquidity needs, loss capacity, and source of edge. A strategy designed for another investor's game may be dangerous in yours. 3. Never invest borrowed conviction. Outside research can begin an idea, but concentrated capital requires personal understanding. Know the economics well enough to remain rational when the original source is absent. 4. Think in probabilities, not promises. Model several futures, not one polished forecast. Expected value depends on both probability and consequence. 5. Separate intelligence from outcomes. A gain can reward weak reasoning. A loss can follow a sound process. Evaluate the result and the decision separately. 6. Keep ego out of the portfolio. Purchase price, public reputation, and personal identity have no economic claim on the asset. Change when evidence changes. 7. Write before you buy. A written thesis exposes weak assumptions and prevents memory from rewriting history after the outcome. 8. Let patience become an active strategy. Prepare slowly, monitor intelligently, and act only when price, knowledge, and opportunity align. 9. Price is what the crowd agrees upon. Value is what the asset produces. The quote is visible. Value must be estimated from cash, reinvestment, duration, and risk. 10. Follow the cash, not the performance trace accounting earnings through working capital, maintenance investment, taxes, and recurring obligations until owner cash is visible. 12. Study the unit before you study the empire. The smallest repeatable unit reveals whether expansion compounds value or multiplies weakness. 13. Demand a margin of safety use price, balance sheet strength, structure, and position size to create room for error. 14. Respect the balance sheet debt maturity, liquidity, claim priority, and asset quality. Determine whether the thesis has time to work. 15. Search for pricing power. The ability to raise realized price while retaining customers protects margins and increases the return on existing assets. 16. Value the reinvestment runway. High returns become extraordinary when meaningful capital can be deployed at those returns for many years. 17. Invest in capital allocators, not merely operators. Study what management does with cash. The next dollar may matter more than the last quarter. 18. Incentives reveal the hidden strategy. Compensation and status systems influence behavior more consistently than corporate language. 19. Judge management by per-share value. Total size can rise through dilution, debt, and poor acquisitions. Owners benefit only when the value of their unit increases. 20. Favor durability over excitement. Estimate how long an advantage can resist competition and what investment is required to renew it. 21. Growth is valuable only when its returns are valuable. Expansion creates wealth only when the incremental return exceeds the capital's cost and risk. 22. Treat acquisitions as investments, not announcements. Include price, integration, culture, additional capital, and the buyer's actual ability to realize synergies. 23. Beware of businesses that must continually be rescued. New money should improve future economics, not merely cover recurring losses. 24. Prefer optionality without paying for fantasy. Own future choices cheaply while requiring the present business to support the downside. 25. Survive first. Continuity is the prerequisite for compounding. Avoid structures where an ordinary error can end the game. 26. Size the position by the downside. Selection and sizing are separate decisions. Confidence does not eliminate liquidity, correlation, or tail risk. 27. Diversify by economic risk, not by ticker count. Look through labels to common dependencies in rates, credit, customers, commodities, and technology. 28. Correlations rise when protection is needed. Most stress funding, ownership, and forced selling behavior, not only calm period statistics. 29. Liquidity is more valuable than it appears. Cash protects obligations and creates the right to buy when urgency makes others sell. 30. Use leverage only when survival does not depend on forecasting. Debt amplifies return and gives the calendar authority. Use it only with durable cash flow and room for error. 31. Know the difference between volatility and impairment. A falling quote may be temporary. Permanent loss comes from damaged earning power, financing, or ownership rights. 32. Build the exit before you need it. Define thesis failure, valuation limits, portfolio risk, and event completion while the mind is calm. 33. The crowd is often right about direction and wrong about price. A real trend can be fully recognized and still be overpriced. 34. Every narrative has an expiration date. Treat stories as hypotheses with milestones and conditions that can disprove them. 35. Fear changes the price before it changes the asset. Prepared capital can buy from forced sellers, but only after testing survival and impairment. 36. Greed compresses time. Restore discounting, milestones, competition, and delay to prices that assume distant success is already certain. 37. Macro conditions matter, but they are not the entire investment. Understand the environment and then trace how it reaches the specific asset. 38. Reflexivity can move prices away from fundamentals. Perception can improve or damage fundamentals through financing and confidence, but every feedback loop meets a limit. 39. Being early is indistinguishable from being wrong without staying power. Direction, timing, carry, catalyst, and financing belong in the same thesis. 40. Never predict without preparing for the opposite. Build portfolios and businesses that can survive a reasonable failure of the central forecast. 41. Build a circle of competence and defend its borders. Knowledge is valuable when the boundary between understanding and assumption is clear. 42. Turn mistakes into intellectual property. Convert losses and near misses into specific improvements in process. 43. Build systems for decisions that repeat. Checklists, gates, dashboards, and decision rights make judgment more consistent. 44. Combine data with judgment. Use evidence to discipline intuition and judgment to interpret evidence under changing conditions. 45. Count every cost. Compare opportunities after fees, taxes, financing, spreads, dilution, time, and attention. 46. Protect reputation as carefully as capital trust reduces friction and expands access. A one-time gain can destroy a long-duration asset. 47. Know when enough is enough to find the purpose and protected floor of capital before ambition creates unnecessary risk. 48. Compound judgment, not merely money knowledge, reflection, character, and relationships improve the quality of every future allocation. Return attributed to skill, or an investment process, beyond the return explained by market exposure and other systematic factors. Alpha is difficult to measure because the appropriate benchmark may be uncertain. A strategy seeking profit from a price discrepancy among related assets or from the expected closing of a defined event. True riskless arbitrage is rare. Most practical forms contain execution, timing, financing, or deal risk. A reduction in an owner's percentage claim caused by the issuance of additional shares or ownership units. Dilution can create value when new capital produces more value than the ownership surrendered. The probability-weighted average result across possible outcomes. A positive expected value does not guarantee a favorable result in one instance or ensure that the investor can survive the downside path. The present value of expected future cash flows minus the present value of required investment. A positive net present value indicates value above the chosen discount rate, subject to the assumptions. Short selling. Selling a borrowed security with the intention of purchasing it later at a lower price. Loss can exceed the initial capital, and the position may face borrow, margin, and timing risk. 48. Law action sheets. Use these pages after reading the corresponding law. The objective is not to produce perfect answers. It is to create a record of thought before circumstances rewrite the decision. Law 1 action sheet. Protect the mind. 1. Name the emotion most likely to distort your next decision. 2. Describe one rule that prevents that emotion from controlling position size. 3. Identify a person or record that can challenge you before commitment. Law 2 action sheet. Define the game. 1. State the exact job this pool of capital must perform. 2. Write the earliest date at which the capital may be needed. 3. Name the benchmark that fits your objective rather than someone else's results. Law 3 action sheet. Own the conviction. 1. Explain the thesis without using language borrowed from another person. 2. List the primary evidence you reviewed personally. 3. Write the strongest conclusion that still depends on outside expertise. Law 4 action sheet. Map the probabilities. 1. Describe the resilience, central, and exceptional cases. 2. Estimate the loss if the adverse case occurs. 3. Record the evidence that would change the probability of each case. Law 5 action sheet. Review the process. 1. Choose one profitable decision that may have depended on luck. 2. Choose one loss that may have followed a sound process. 3. Write the process change, if any, justified by each result. Law 6 action sheet. Remove ego. 1. Identify a position connected to reputation or identity. 2. Answer what you would do if you owned none of it today. 3. Name the fact that would make a change of mind rational. Law 7 action sheet. Write the thesis. 1. State the opportunity in one economic sentence. 2. List 3 facts that must remain true. 3. Write the kill criterion before entering the position. Law 8 action sheet. Practice active patience. 1. Name one asset you understand but would not buy at today's price. 2. Set the price or condition that would justify action. 3. Describe what you will monitor while waiting. Law 9. Action sheet. Separate price and value. 1. Estimate a conservative value range without looking at the latest quote. 2. List the assumptions that create the upper end of the range. 3. Calculate the expected return at the current price. Law 11. Action sheet. Explain the business. 1. Describe why the customer buys. 2. Name the variable that most strongly controls margin. 3. Explain how a competitor could weaken the economics. Law 13. Action sheet. Build the buffer. 1. List the errors the purchase price can absorb. 2. Identify one structural source of protection beyond price. 3. State the event that would eliminate the margin of safety. Law 14. Action sheet. Stress the balance sheet. 1. Create a maturity schedule. 2. Estimate liquidity after a severe revenue decline. 3. Name the covenant or obligation most likely to transfer control. Law 15. Action sheet. Test pricing power. 1. Review the last realized price increase. 2. Measure retention, volume, and discount behavior afterward. 3. Identify why customers did or did not accept the change. Law 16. Action sheet. Measure the runway. 1. Estimate how much capital can be reinvested attractively. 2. Name the evidence that expansion is repeatable. 3. Describe what management should do when the runway narrows. Law 17 Action sheet. Rank capital uses. 1. List every realistic use of the next dollar. 2. Estimate the return and risk of each use. 3. Explain why the chosen use is superior to distribution or debt reduction. Law 18 Action sheet. Map incentives. 1. Identify the metric that drives compensation. 2. Describe one harmful behavior that can improve that metric. 3. Propose a measure that better aligns long-term ownership. Law 19 Action sheet. Think per share. 1. Calculate the change in diluted share count. 2. Separate total growth from per share growth. 3. Explain whether issuance or repurchases created value. Law 20 Action sheet. Test your ability. 1. Name the source of competitive advantage. 2. Identify the investment required to maintain it. 3. Describe the most credible route by which the advantage could decay. Law 21. Action sheet. Price growth. 1. Calculate the incremental return on recent expansion. 2. Separate organic, acquired, price, and volume growth. 3. Identify which growth initiative should be stopped first if returns weaken. Law 22 Action sheet. Underwrite the deal. 1. Add integration and working capital needs to the purchase price. 2. Separate controllable cost synergies from uncertain revenue synergies. 3. State the maximum price before the auction changes your judgment. Law 23 Action sheet. Test self-sufficiency. 1. Calculate the months of liquidity under a conservative plan. 2. Identify the milestone that makes new financing optional. 3. Explain whether new capital improves economics or merely delays pressure. Law 24 Action sheet. Value the option. 1. Identify the specific asset creating future optionality. 2. Estimate the capital required to test the option. 3. Determine how much of the current price already assumes success. Law 25 Action sheet. Design for survival. 1. Name the single event that could cause irreversible loss. 2. List the reserves available if markets close. 3. Write one change that reduces ruin risk without destroying the strategy. Law 26 Action Sheet. Size the downside. 1. Estimate permanent loss under the adverse case. 2. Measure how the position interacts with existing exposures. 3. State the maximum size that preserves rational behavior. Law 27. Action Sheet. Map economic exposures. 1. Group holdings by their true drivers of return. 2. Identify the largest hidden concentration. 3. Choose one exposure that would diversify the cause of failure. Law 28. Action Sheet. Stress correlations. 1. Model a joint liquidity and credit shock. 2. Identify assets that may be sold together by the same owners. 3. List the capital calls or margin needs that could arrive during stress. Law 29 Action Sheet. Organize liquidity. 1. Separate immediate needs, reserves, and opportunistic capital. 2. Estimate the discount required to sell each major asset quickly. 3. Define the condition under which cash should be deployed. Law 30 Action Sheet. Audit leverage. 1. Calculate debt service under lower earnings and higher rates. 2. Determine whether principal can be repaid without refinancing. 3. Name the party that controls timing if the forecast is late. Law 31 Action Sheet. Diagnose the decline. 1. Identify the new fact behind the price movement. 2. Explain whether it changes cash flow, duration, or financing. 3. Update value before deciding to buy, hold, or sell. Law 32 Action Sheet. Write the exit. 1. List every evidence-based reason to sell. 2. State the expected return required to continue holding. 3. Define the conditions for partial reduction and complete exit. Law 33 Action Sheet. Price the trend. 1. Describe the real change the crowd has recognized. 2. Translate the current price into required revenue, margin, and duration. 3. Identify who captures the profit across the value chain. Law 34 Action Sheet. Set the story's expiration. 1. Rewrite the narrative using measurable facts. 2. Choose the milestone and date that should provide evidence. 3. State which result would invalidate the story. Law 35 Action Sheet. Prepare for fear. 1. Name the forced sellers likely to appear in a crisis. 2. Identify the assets you would want at a severe discount. 3. Calculate the liquidity available to act without borrowing. Law 36. Action Sheet. Restore time. 1. List the distant milestones embedded in today's price. 2. Delay each optimistic assumption in the model. 3. Recalculate value using a more demanding discount rate. Law 37 Action Sheet. Connect macro to the asset. 1. Identify the two macro variables that matter most. 2. Trace the mechanism from each variable to cash flow. 3. Explain how the asset performs if your macro view is wrong. Law 39. Action Sheet. Finance the wait. 1. Estimate how long the thesis can take. 2. Calculate carry, option decay, or financing cost over that period. 3. State the catalyst and what happens if it never arrives. Law 40 Action Sheet. Prepare for the opposite. 1. Write the scenario opposite your central forecast. 2. Identify the first protective action in that scenario. 3. Confirm that the portfolio survives without forced selling. Law 41 Action Sheet. Defend the circle. 1. Name the industries or assets you genuinely understand. 2. Identify one area where confidence exceeds evidence. 3. Choose the study required before the circle can expand. Law 42 Action Sheet. Convert the mistake. 1. Describe one recent error without blaming the outcome. 2. Classify it as analytical, behavioral, process, or execution. 3. Write a specific rule that changes the next similar decision. Law 43 Action Sheet. Systemate is the repeatable. 1. List the investment decisions you make repeatedly. 2. Choose one checklist or gate that reduces omission. 3. Define the measure that will show whether the system improved. Law 44. Action Sheet. Balance data and judgment. 1. State the base rate relevant to the decision. 2. List the specific evidence that justifies an adjustment. 3. Record any human override and the reason for it. Law 45 Action Sheet. Calculate the net. 1. List every fee, tax, spread, financing cost, and dilution source. 2. Estimate the value of time and attention required. 3. Compare the net result with the best available alternative. Law 46. Action Sheet. Protect trust. 1. Identify the stakeholders relying on your promises. 2. Describe one profitable action that could damage long-term credibility. 3. Choose the standard you would defend if every fact became public. Law 47. Action Sheet. Define enough. 1. State the capital required for essential freedom. 2. Separate protected capital from ambitious capital. 3. Write the risk you no longer need to take. Law 48. Action Sheet. Compound judgment. 1. Name the skill that would most improve future decisions. 2. Choose one relationship or discipline to deepen this year. 3. Define the review loop that converts experience into better judgment. January Capital Review. Foundation. 1. Which objective deserves the largest share of attention this year? 2. What obligation must remain protected regardless of markets? 3. Which portfolio rule needs to be restored before activity increases? February Capital Review. Valuation. 1. Which holding offers the weakest expected return from today's price? 2. Where does the market appear to underestimate normalized earning power? 3. Which valuation assumption requires fresh evidence? March Capital Review. Cash. 1. Which asset converts accounting profit into cash most reliably? 2. Where is working capital absorbing more money than expected? 3. What source of liquidity should be strengthened before the next quarter? April Capital Review. Management. 1. Which management team allocated capital most intelligently? 2. Where did incentives produce behavior inconsistent with ownership? 3. Which leadership change would materially alter a thesis? May Capital Review. Risk. 1. What common factor now connects several positions? 2. Which downside has grown while price attention remained elsewhere? 3. What exposure would be hardest to exit during stress? June Capital Review. Mid-year Truth. 1. Which original assumption has proven wrong? 2. What result came from luck rather than skill? 3. Which decision should be changed before the year continues? August Capital Review. Competition. 1. Which business is strengthening its advantage? 2. Where is a competitor changing the basis of competition? 3. What investment is required to defend the moat? October Capital Review. Cycles. 1. Which holdings depend most on credit, rates, or inflation? 2. What scenario has not been represented in recent experience? 3. Where would a cycle reversal create opportunity? November Capital Review. Gratitude and enough. 1. Which financial outcome expanded genuine freedom? 2. What risk is no longer necessary to take? 3. How can capital serve a purpose beyond comparison? December Capital Review. Annual Judgment. 1. Which law prevented the most expensive mistake? 2. What knowledge compounded most during the year? 3. Which 3 changes should govern next year's capital? Decision Record 8. The downside. 1. What is the most plausible permanent loss path? 2. How much can be lost before the portfolio is impaired? 3. What structure limits the damage?